Welcome back to FT Global Boardroom. I'm Andrew Edgecliffe-Johnson. I'm the US Business Editor of the Financial Times. And as you just saw, the future of capitalism is a rather large subject. So Rebecca and I didn't have too much time to discuss the COVID-19 pandemic with the late great Milton Friedman in that video. But the pandemic has hugely changed the focus on the topic of our next discussion, which is how companies should put their own people at the core of their businesses. We have seen fairly obvious concerns this year about worker safety, but we've also seen strikes. We've seen a barrage of headlines in the FT and elsewhere about workers' rights, to everything from PPE to paid sick leave. And low-wage work has come under greater scrutiny than ever before, as we've seen the disproportionate toll that the pandemic's taken on the lowest paid members of our workforces. And for those of us who used to think of our office jobs as a little humdrum, the prospect of going back to one's desk can suddenly look distinctly fraught, while working from home is raising huge questions about employees' workloads and mental health. But if and when we ever emerge from the COVID era, what lasting changes will we see in how companies better listen to the concerns of their employees? So we have a lot to discuss, and I'm delighted to be joined today by three panelists who bring unique and varied insights to our theme. We have Bruce Simpson, the senior partner of McKinsey, Rod Little, CEO of Edgewell Personal Care, which is the company behind brands like Schick and Wilkinson Sword razors and Hawaiian Tropic sunscreen. And we have Rebecca Henderson, who just saw on that video, a Harvard professor and author of Reimagining Capitalism in a World on Fire, is, as you now see, the tormentor of Milton Friedman's ghost. So I'm going to start with Rod, who reported earnings this morning for Edgewell. And while sales of razors and sunscreen are recovering from their lows of the previous quarter, people just haven't been shaving as much, including myself, or going to sun-kissed beaches as they used to this year. So can you afford to prioritize employees in a context like this when sales are down and you're trying to figure out how to get them growing again?
Yeah, hello, Andrew and everyone out there. It's great to be here today. I have a good fortune. Let me just give you a quick background on the company. We're 6,000 employees, 4,000 operation day-to-day manufacturing around the world, 2,000 headquarter office jobs, if you will. So we have jobs across the spectrum to run our business. And one of the things I've had the good fortune of doing is spend time in the US military, which is a promote from within culture. You become a general or an admiral only by growing up through the ranks. And I spent 17 years at Procter & Gamble, another promote from within culture. And so both of those cultures value the employee as the most important asset. And so I bring that with me here to Edgewell. People are our most important asset. We redid our values this year, Andrew, and we started with the leading value. We have 4 of them, but the number 1 value is people first. And so when you say that publicly and you say that to your employees, you have to follow it up with action. And so I'm a big believer in engagement and positivity and having people come to work motivated and fired up to give their very best. And they only do that when you treat them well.
I want to drill down a little bit into what people first means later, but have you seen a trade-off this year between just the pressure on the top and bottom lines and that desire to keep people first?
Now, we've spent more, so our cost around people has actually gone up. That's been intentional. And I'll give you just one example, Andrew, of how that plays out, and it's a COVID-specific example. Back in the spring, early days, this began in China. We have manufacturing for Asia in China. We took all the lessons learned from China and brought them back to the States, because most of our manufacturing actually is domestically here in the United States. And so we brought those lessons learned back. One of the things we saw early is we needed to focus on health and safety first and foremost of our people. And that wasn't just a statement that we took lightly. Continuity of our operations and manufacturing depended on it to keep the manufacturing and supply chain moving and virus-free. So one of the things we did at the very beginning is we instituted a pandemic leave pay policy. that did a very simple thing. It gave our manufacturing and operations people the incentive not to come to work. If they were sick at all, if they had been exposed to someone who was sick, or if they just needed to go sort out childcare because school had shut down and they didn't have coverage for their children. We gave everybody 2 weeks full pay to go sort that out when they needed, when they needed to take it, and another 12 weeks at 70%. Normally if you're not showing up in manufacturing, you're not getting paid. So we essentially gave people 14 weeks of flexibility and coverage that cost us because we had to backfill with temps and other people to go do that. But the value we got from loyalty and appreciation from the employees beyond it just being the right thing to do and keeping our operations virus-free has paid off with increased engagement and positivity scores back from that group.
Great. Bruce, I want to come to you and sort of ask how widespread that kind of response has been. I remember you and your colleagues wrote something back in March, which I'll read back to you briefly. You said, in this crisis, stakeholder needs are already so acute that the opportunity for businesses to make an indelible mark with human support, empathy, and purpose is greater than it's ever been. I guess my question is, how many of your clients were really listening to messages about human support and empathy as their revenues were falling off a cliff?
Well, we've seen both ends of that. I think on the positive side, I think COVID particularly showed the heroic work that some of the frontline is doing, stacking grocery shelves, frontline healthcare workers. That's the stuff that's been keeping society going. And a number of companies have absolutely stepped in to zoom in on, well, what is the plight of those frontline employees? How are we actually paying those people? Striking maths, before the pandemic, 50% of workers at Russell 1000 companies weren't making enough to support a family of 3, even with both of the adults working. Frontline pay has not gone up in the US in 40 years in real terms. That's an absolute disgrace. What's been happening is the enriching of the 1% at the expense of the 99%. And that maths is then flowed out into the streets, as we see with COVID and Black Lives Matter and the protests. And that's presented, I think, a real moment of choice. A number of companies have stepped up big time, understanding that the employee is actually the most important stakeholder group during a crisis like this. And at the same time, our recent research would also show that people feel only about 1/3 of the companies have done that well. So we see both ends of the spectrum in terms of delivery. Interestingly, where companies have stepped up, we also see a terrific uptick. Companies like PayPal will come back to. They increase frontline pay. Others have done that too. Microsoft, similarly. And a number of others, IKEA, there's really good cases for it. Where they have increased their investments in the front line through pay, through skills, training, then there is a return for that through time, because that also increases loyalty, it lowers attrition. And so there's a business case for doing it if you can let the maths work out through a couple of years, as well as it being the right thing to do.
Yeah, and that's an interesting distinction between the different tiers of companies and the sort of third who've done as well and the others who've not. But so Rebecca, I want to hear your thoughts on what Bruce just said there, because his point about real wages having stagnated for so long for so many people in the workforce is a really important one, I think. And this was happening in a historic bull market. The last 10 years pre-pandemic, profits were plentiful, and on conferences like this, the main thing we were talking about was, when it came to employees, was how scarce talent was. It seems to me that those two factors have flipped. Profits are now much harder to come by, and talent is unfortunately rather plentiful, given how many companies have had to cut jobs. So does this equation still work in a tougher economic time?
I think it does, but not easily. This is not a matter of, just pay a bit more and treat people better and increase benefits and give it a few years and you'll see the returns to your bottom line. I think the research suggests pretty clearly
Okay, ladies and gentlemen, I'm placing an order to sell short euro at 117.99.5. 117.99.5.
Real in increased productivity, in increased creativity and innovation, if you've given them the freedom to be more innovative, to make a difference in how their work is done. If your
position opened at 117.99.5.
is, yes, it may give you loyalty over the longer term, and yes, it's the right thing to do, but the real win is when you build the company around treating people this way. And when you do that, the wins, I think, are very substantial and significantly long-lasting.
Mm-hmm. So that's a much more cultural point. That's about the sort of internal culture of the company. And
Andrew, don't reduce it to culture. No, please.
You say that culture is a bad thing, Rebecca. So explain your reaction to this idea.
No. So let's take the work of Zeynep Ton at MIT, who's really looked at this in detail in the retail sector. So these are blue-collar people stacking shelves, greeting customers. What she finds is if you give them more autonomy and more ownership of what they're doing, they do those jobs much more effectively. That they make the decisions about what to put on the shelves, and they make the decisions about how to lay out the store. And that's real. That's not cultural. That's really giving power to people on the ground to make different kinds of decisions. And yes, you need to change the culture as well, but it's very hard and very real when you try and implement it.
Both these, let me quick build.
Yeah, Bruce, good.
Yeah, quick build on that. So right there with you, Rebecca, there's a cultural piece which is at the level above those people who should be making decisions, needs to be supportive of development and training. The most important relationship one has at work is with one's boss. And the boss tends to set the culture. However, the decision-making, there's terrific maths on employees being 4 times more engaged if the decision-making is structurally moved to them. And a good example, I was actually on a conference event this morning with the ex-chairman of Best Buy, who led a terrific transformation of Best Buy in the US. And he said the word standard operating procedure at Best Buy means service over process. And he allows the front line to make on-the-spot decisions to give a discount to a customer without having to get the approval of the level above. And we see that decision-making pushed to the front line in other places too, which then gives them a sense of being in charge, which then has a terrific uptick in then their engagement.
Okay, I'm not going to use the word culture here, Rod, but I want to bring you back in on the corporate philosophy that you were talking about earlier when you talked about this people first idea at Edgewell. What did that look like pre-pandemic? You talked about some of the measures you've taken this year to sort of bolster that philosophy, but what did you mean by that 12 months ago?
Yeah, I think Rebecca and Bruce just hit on the key points. One is getting people off the sidelines and engaged and feeling like they're part of the future and part of the company and that they can make a difference and have a voice. It's very easy to fall into the trap of command and control, and my role is to follow orders and direction, and it's always what we've done. And there may even be reward mechanisms in place that encourage that. For example, one of the things I've seen a few different places is bad news just doesn't flow up to the top. Like all you hear are the wins and the good news. Everyone's very hungry to tell that, but not the bad news. And it's the bad news many times that's going to hurt results and have a really negative outcome for the company. And it's that freedom of people, regardless of where they sit, to have their voice heard and have that come up is really important. And that's actually our third value: listen up and speak up. So be a good listener, but if you have something to say, say it. And I even say, if you've got something to say, come to me directly. Send me an email. I don't care who you are. Call me. I'm open for feedback. So that's the first point. The second one, Andrew, just I'll go back to Bruce's comment because it was so right on around this learning and development and the investment in that, because you have to empower people to speak up and feel like, all right, I've got a role and a voice. but they have to feel like they've been invested in, and you have to invest in people. And we came through a culture, back to your question, to me, a time period where we were cutting cost and cutting cost and cutting cost again. And a lot of it started to look like just take away from the people, regardless of level, and very little investment in making our people better. And so we've started to put that back in as well. So you have to have both of those in place.
There's a check and balance. I would just add quickly too, which where employees are not given what Rod just described, they will today go to social media to complain about it.
Yes, they will.
And a number of the tech firms that we think have under-delivered actually in the last while suffer because their own employees, rather than raising it internally, perhaps they have already, will go to social media to say, wait a minute, we want to be heard, and they will be heard through social media unless they're given what we've been describing.
I think this point about how do you make sure messages, bad news is filtering up is, I want to stay on this for a bit because we've actually got three sort of related questions coming in from the audience. And by the way, I hope everybody in the audience is going to keep peppering us with questions here. But question one, what are the metrics today that inspire employees to see, to realize, to experience moral money leadership from their employers? What are tomorrow's metrics? Related question two, how can leaders translate this approach to balance sheet metrics that prove increased value to the enterprise? Because employee satisfaction scores do not show up on a balance sheet. And I think, again, related question three, if companies put people first, how can impact best be measured? So there's clearly an anxiety about how do we measure this stuff, both for the kind of the purpose of making sure the messages are being heard by CEOs like yourself, Rod, but also for investors, so the outside world can see what's actually going on the employee front inside these companies. Who's got thoughts on that? Rod, do you have a feeling for how we should be measuring this better?
Why don't I kick off?
Yeah, go ahead, Rebecca.
No, Rod, you're doing it on the ground. Go ahead, Rod, really.
I'm sure, Rebecca, you have better measurement thoughts than I do on it. But I would just say a couple of things to that is, if you have one amazing employee who's engaged and brings their very best every day, they're worth more than 2 or 3 average employees. And so I think if you have everybody showing up every day, highly motivated, clear on what it is they need to do, feeling valued, bringing their best, there's a productivity gain from that versus just having people on the sidelines going through the motions and just collecting the paycheck. And so I really do believe there's value in that. And translating it to the balance sheet and P&L, when you have a workforce of highly engaged people that really care about the results and feel like the company has their back, they're building better plans, they're building better programs, they're putting things into the market in my business that better connect with consumers, and the results follow. I think from my time, again, this is probably maybe where Rebecca's going, but I've seen study after study that correlates high levels of engagement over extended period of times with outsized results in terms of shareholder return. So to me, they're in the same zone.
So let me leap in here with the measurement point. I think measures are so important, right? What gets measured gets managed. And if you're going to invest in your employees, you need to persuade your investors that look at, and that, yes, it might ultimately be correlated with long-term profits. How to measure these, we know. So employee engagement, one of my colleagues did a survey of employee engagement with 4 million surveys from the company, The Better Places to Work. What he found, Rod, I think is super interesting, is there's no correlation between engagement and performance. It's only when employees have a clear sense of the strategy of the company and how their work contributes to that strategy, that's when you get the bottom line impact. So you can have super happy employees and, alas, not have, great financial results. But that's the kind of nuance that investors need to come to understand, that as we get meta measures, investors will reinforce these kinds of behaviors. I think the other reason measures are so key is because employees want to know their work is making a difference. And I think the pandemic has really increased that. And so measuring the impact of the firm, jobs created, reduction in environmental harm, impact on the local community, increased in, I'm sure, Rod, you think about this, increase in self-esteem and happiness among customers. I mean, these quantities that sound, well, how would you measure that? We can measure this. And there are huge numbers of important things, non-financial, materially important things that we're not measuring, and we should.
Bruce, have you seen great ways of measuring that?
Absolutely. So quick build. So I think, first of all, in today's world, the first thing that needs to be measured is the economic fragility of our own frontline workers. And there's been some great work that companies have done on that one. So first of all, are they actually earning a living wage? And that's something that needs to be measured, because if they're not, then those employees are worrying about a lot more that goes beyond the corporate frontier. And so that's a key measure right now. And that's where PayPal, I think, has really led the charge. I think we're going to come back to them in measuring that economic fragility and then increasing frontline pay and training, making them shareholders, which then brings them in from the cold, which then leads to terrific uptick in loyalty and lower attrition and so on. So that's a key metric, needs to be there today. For shareholders, the key trade-off is not between, if you like, purpose and profit, it's between long-termism and short-termism. And companies that make short-term trade-offs, for example, laying people off while doing a share buyback, for example, those companies are going to be slammed for doing this, because that's at the short-term benefit of one stakeholder group, at the long-term fragility of their ecosystem in which they operate. And we've done some terrific research over 15 years, which shows that companies that think for the long term do win over the long term. And that means thinking about all the stakeholder groups, the suppliers, the customers, the employees. So message to shareholders, measure long-term benefits versus short-term. At the same time, 65% of CFOs confess to us they would veto a positive NPV project if that was going to cut into short-term earnings. And that's the real issue. At the same time, there should also be signature initiatives which the company commits to, which are clearly measurable. Companies talking about 2050 carbon neutrality. That's a joke today. You need to be talking about 2021, 2025. In order to be taken seriously. So there should be some measurements which are more short-term, to employees, what we're doing for the environment, but then others which are more long-term. And each stakeholder group needs to have its set of metrics in the mix.
This isn't an easy solve. Andrew, if I could just jump in on this, because Bruce and Rebecca are absolutely right. The reality, though, on the ground is this is a global issue, right? This is absolutely a global issue. Let's just take one easy example. Today, Edgewell, we grind razor blades in the US here in Connecticut, and we do it in Germany. My number one competitor does it in Mexico, Brazil, Vietnam, and Poland. I've got a big cost disadvantage, right? So there still are cost incentives in the global setup in terms of just how things are structured, where there's cost advantage to be had by geographic moves and how all of this gets put together. So it's very complicated. And one of the things I think it's back to us all working together as a global community on the problem is having some standards and benchmarks around, what is fair.
This might be a question for Rebecca or Bruce, but I think this is a really important point that Rod is making. Labor has been seen as a cost to be managed, for decades. Is it just going to be pay rises all around now? Is the cost of labor going to have to go up to accommodate the desires of these increasingly noisy stakeholders we call employees? Is there a fundamental change in business models coming because you're just going to have to pay more for labor? Rebecca?
Building on Rod's comment, I think it's critical that we move towards consensus on paying more in global supply chains. So you see groups like the Sustainable Apparel Coalition or the Roundtable for Sustainable Palm Oil, or any one of a number of industry groups that are trying to ensure that overall labor conditions improve in the global supply chains. So at some level, it's appropriate, I think. I mean, China brought 1 billion people out of poverty, And, they're doing low-wage jobs, they're doing them well. If we can find ways to do value-added jobs in the US, that's going to work out well. But to the degree that people were offshoring jobs to very badly run companies where people were really being taken advantage of, that I think is something that we really need to address. So yes, I do think wages should go up globally, but I think that could be a plus for the world economy. After all, when people are paid more, they have the ability to buy more, they have the ability to invest more in their children. It's not a bad thing overall to pay people more.
You just
a quick build on that.
Investors in that. Yeah, Bruce.
Well, actually, so right there with Rebecca, absolutely resounding that we have to increase that frontline pay. I mentioned the statistic before of families in America, half of them in the Russell 1000 can't even support a family of three. So frontline pay has to go up. It's not a cost, it's an investment. That investment brings back a terrific return. Workers that are treated fairly are much more productive. There's also the challenge today that, perhaps one of the biggest business issues today is that 70% of the workforce is disengaged at work. They don't actually care because they don't feel that connectedness to an employer that's not really taking care of them. And they bring to work discipline and rigor. They leave at home creativity, initiative, and collaboration. You invest more in that frontline worker, you're going to get the whole person coming to work that is then going to inject more into the day job. And there's good research. Companies that pay a living wage have 30% less turnover. And some great research from Just Capital recently, which showed that companies that score in the top quartile for fair pay have 6.5% higher returns relative to their peers. Lowest paying companies have a negative 3% return. So it's an investment. It does return, and more companies should be doing it.
So
and I agree. I think see more and more data to support that. Rebecca, yeah.
Could I pile on just quickly?
Always happy to have you pile on.
We need a stable society in which people are convinced of the legitimacy of capitalism. I've just published this book, Reimagining Capitalism. I'm surprised by how many people say to me as I talk about it, why reimagine capitalism? Why not just throw it out the window? I mean, the statistics that Bruce is citing, a lot of people think the system isn't working for them, that they're at the bottom, that those at the top have run away with all the gains. It's very dangerous for the long-term stability of the whole system. So in addition to, yes, you can make more money, let's remember and we'll build a healthy society. And we know that's a better place to be growing and thriving.
Well, if I can, in your shoes, Rod, that sounds like a pretty big demand, for you to, as a capitalist, as a CEO, to kind of rethink the whole system, But you, to Bruce's point, you can control more micro stuff. You can be on top of what whether or not your employees are earning a living wage, as the folks at PayPal have been, asking their employees. What do you think your part in this battle is?
Yeah, no, I agree with that. I've got a responsibility as the CEO of a company that employs 6,000 people. I'm responsible for their well-being and their families and how they operate, not only at work, but what do they do when they're outside of work. I feel a responsibility for that. I think Bruce is making a point. There's two financial levers here that higher pay, better compensation packages. I want to come back to that in a minute when I talk about comp and benefits. It's the totality of the treatment of the employee are hard financial benefits. The first is the productivity point. Getting the 70% that are disengaged off the sidelines and fully engaged, breakthrough and fundamentally cheaper in terms of just productivity because of what they can then produce. There's a productivity gain, there's no doubt. But the second piece of it is when you have high levels of turnover and people are just shopping for who's going to go pay the next wage and you get into losing 20 to 30% of your workforce, it costs you to go recruit and bring those people back in. The training cost in our environment where there's significant value-added labor, being a master blade grinder takes a decade to get someone up that learning curve. Those investments back in are real cost. And so if you can retain your best people and get them off the sidelines, there's real tangible benefit there that a higher wage, a better benefit package can afford. And I think beyond just the pay itself, the dollars have to be right. But how do you think about healthcare and what you offer the employee? That's important today more than ever. How do you think about 401k matches and the level of the match that you give? How do you think about flexibility, again, with an hourly employee that needs to go deal with a family emergency? You know, in our worlds here in the office setting, you have that problem, you move the meeting and you go deal with it. When you're frontline hourly, you can't or you don't get paid, right? And so having some methods to deal with that and treat the employee very fair beyond the wage that's paid, which absolutely has to be at that living standard. It's the total package of that that ultimately builds the loyalty.
Bruce, I don't know whether this one's Bruce, Rebecca, or Rod, but when you look at this question about pay and benefits, about the overall package, what do you think is actually going to make the biggest difference to that engagement challenge? Is it going to be another 5% on your wages each month? Is it going to be the sort of paid sick leave type benefits, or is it going to be the security of a better pension? What do you think actually makes the biggest difference?
I would nudge that look, there's a threshold we have to get to in terms of basic frontline pay, right? What's the net disposable income of my frontline after they have paid for rent and food and the basics? And you need to get that up to a number in the region of maybe 20% net disposable income, as opposed to 4 to 5, which is what PayPal found when they first did their assessment, and then they upped the pay and so on. However, I think the big thing is, and Rod made this point, it's investing in the future of your employees. It's a lot about training and skill building. Walmart's program, Walmart did a terrific job of both increasing frontline pay, but also investing in the skill building and the training. So you invest in their skill building, that then gets them up the job ladder, and it's more about lifetime security and employability versus just the wage bit. We should remind ourselves, too, that maybe 30, 40 years ago, 80% of a company's value was in its fixed assets, property and equipment. 80% of the value today is in the soft assets. It's R&D, it's patents, and it's the employees. And so that long-term investment in employees to move them up the ladder, skills, career progression is the winner.
I want to bring in a question. Rebecca, do you want to respond to that?
So just quickly, I'm curious, Bruce. I thought the research was pretty clear that you fix the wages, you invest in trading and investment, but people need to feel they're treated with dignity and respect, that they are part of the mission of the company, that if you continue, that you really need to treat people as human beings to really get most of the engagement. Do you see that?
Yes, it's another layer. So there's if you think about thresholds, first of all, it's that frontline pay and benefits. Biggest issue in America today, it's pay, benefits, and then training and skill building, and climate comes after that. In addition, however, if you can then encourage them to feel that in their day job they make those decisions, the point you made earlier on, then there's another uptick that comes from the employee who is then bringing more of themselves to work. So it's an additional surplus and a benefit that comes if the decision making is redesigned, so purpose is actually built into frontline decisions, and that's another benefit.
Can I come to a question about the pandemic? Rebecca, as you and I discussed with Milton, expectations on companies around this issue were already building long before COVID-19 hit our screens. And the pandemic has clearly changed expectations on wages and on benefits like paid sick leave. But it's also scattered a lot of workforces. We have a lot of people working, as I think most of us are, from their homes. And as one of the questions I'm seeing here from our audience says, there's research coming in that has revealed a third of home workers feel disconnected to their organizations and colleagues. What are the implications of that, and how do you manage it? Rod, do you have a lot of your team working remotely still, and have you figured out how to manage that?
It's one of our big challenges with 4,000 frontline that need to be in the place of work every day and put their personal health and safety on the line. And then we've got 2,000 people that we actually don't want to go into the office right now. We've instructed not to, and to work remotely. At the beginning, there was a novelty to it, right? I think there was a settling in period. Fortunately, people like Zoom and Microsoft Teams have gotten the technology to a place where you can actually conduct your business remotely and actually be quite good at it. And we've found our productivity and everything we need to do to run our business in those 2,000 people that don't need to be in the office is actually working quite well. But there's a fatigue factor that is just really problematic. And it's something that I think, coming out the other side of this, one thing that has been redefined is this idea that I'm in the office every single day and FaceTime really matters like it used to. I think we've proven there's other ways to get work done. And so I think as we blend it, I'm optimistic that we can still be productive in a new world where it's not in the office every day, but being connected to your teams is so important. We now have over 100 people in the US alone that have been hired without meeting their teammates virtually. My head of North America is that way. So from the most senior positions all the way down to entry level. And that's just not sustainable. When we talk about building the bad word of culture and defining the norms of the company and how we're going to treat each other and behave and what we value and don't as a company, it's really hard to do that virtually.
Bruce?
Well, I was just building on what Rob was going, that work from home, we're doing a ton of work from home. What we're finding is actually quite efficient to deliver projects. It's not effective, though, for client relationship building and client development. So because that personal connectivity is just lacking. It's also brought a huge collateral issue in terms of mental health challenges. I don't actually wear glasses, but I'm wearing these because the tint stops the fatigue from being on Zooms 15 hours a day. 41% of American adults struggle today with mental health issues coming from the pandemic. It's almost as if we were at war. If you think about PTSD, and already prior to the pandemic, loss of productivity from mental health added up to about $1 trillion a year, absenteeism and less engagement and so on. So there's a big challenge today in dealing with this new environment where we haven't got that connectivity with our teammates, which bolsters us and feels us better. And of course, we have other stresses and challenges. And that requires, I think, quite a big rethink to make sure that we're dealing with some of the collateral damage, if you like, of a situation that we're in.
I think that's a really important point, and a lot of what we're discussing here, I think, comes down to the same idea, which is that what we used to think about as the softer stuff in companies like mental health and how people are feeling is suddenly really, really important to your bottom line.
Hey, Andrew,
you talk about self-care, the importance of self-care in Edgewell. What do you mean by that, and how have you tackled this problem?
Yeah, so 2 examples, just building on where Bruce was going there. We use this tool called Waggle. It's like a survey monkey. It's a real-time pulsing of the organization where you can just get real-time. How are people feeling? And one of the things we picked up as the pandemic wore on was this mental exhaustion. The PTSD, if you will, where Bruce was going, was real. And you go from family groups who are trying to manage children virtually online with school to isolated individuals who are lonely and have no other connection, right? So it's the gamut of that. One of the things we just asked them, like, what would help look like? And what came back was less time on the screen. And so we did a couple of things. We mandated over the summer 6 what we called Take a Break Fridays. In addition to vacation packages, our normal company holiday structure, we threw 6 extra Fridays in because, to Bruce's point, we were very productive and efficient. We were getting the work done. And so we just mandated globally, all offices closed, no meetings, no phone calls, an extra day, go uncharged with a long 3-day weekend. And we then modified that when we got through that period because that screen time was still an issue. And we've gone to now meeting-free Fridays. So you're not allowed to schedule a meeting with your peers at Edgewell on Fridays. It's a personal day to catch up, get your work done, get organized for the week ahead. And that has been hugely well received by the employee base just to have a day where there's not screen, sun up to sundown.
I can see that'd be pretty popular. Rebecca, we got a question in the chat here about education, about business school education in particular. You teach leadership. What we're talking about here is that relationship between team leaders, managers, and their employees. How much are the business schools who nurture future leaders going to have to change their curriculum to incorporate these principles that employees and people should be put first? Are you already seeing that happen in the way that you think about the Harvard Business School curriculum?
It's been happening for a while. The research consistent with what Rod and Bruce are telling us is very strong, that this kind of inclusive, participative, distributive, empathic leadership is absolutely the way of the future. My favorite statistic is that in every industry, the top 10% most productive firms produce more than twice as much as the 10% least productive firms in every industry. I spent 20 years in windowless conference rooms trying to make this result go away because it wasn't driven by the quality of the technology or the education of the workforce. It was some magical thing called management. So the research is very strong. What's interesting is we have old models. And Rod, you almost started us off there when you said people are our most important asset. Well, that's true, but it's a weird way to put it in some ways. And I know you know this, right? People are people. They're not assets. Mm-hmm. So it's changing the whole culture of how we talk about what it means to be a business leader. But I mean, there are hundreds of business schools across the country moving in this direction. And we have fantastic examples of companies leading the way in this area. So I think it's something that's very much underway.
So there's a big change.
Bruce, quickly, yeah.
Well, I was going to say, building on Rebecca was going, we see a big change in leadership styles which work in today's environment. And frankly, the old traditional let's take the hill type leader, who the highly enthusiastic lead from the front, charge up the hill, tends not to work today anymore because those leaders have a dark side, which is they don't listen too well to what people are actually feeling. And today we see a leadership which is shining, which is much more about actually listening to employees, personal vulnerability, sharing, empathy, as Rebecca had said, people who create an environment for others to step up and say, you know what, I'm not feeling so great either. I do have this issue, this challenge. An environment where people can actually speak up. I think Rod made the point about, talk up, listen down, if you like, or something like that. That's very prevalent today. That was not the case a few years ago, and different leaders are shining.
I want to throw in a quick final question from our audience here. As Rebecca said, we've been talking about people being our greatest assets for a very long time now, but not much has changed. So is it time to actually have a little regulation imposed on this? What do we need government to take more of a role in this challenge? If so, what could governments and regulators helpfully do?
I'm happy to throw one thing. So I think one of the message back to companies, first of all, there's at least three de minimis things you need to do. One, work with government as opposed to undermining it. $3 billion spent every year in the US lobbying Capitol Hill. That is not good for Joe average people like us. It might be good for short-term shareholders. It's not good. Governments need to step in and regulate. The other two things, by the way, that companies need to do: pay your taxes. If you're not paying your fair share of taxes, then frankly, everybody is a loser long term. And then pay your workers fairly. We've talked to that. Governments need to step in and regulate the tech sector. They've done a miserable job of self-regulating, and their own employees are revolting and saying, wait, what about more regulation for my own sector in areas of data privacy, taking care of your own employees? And we need to give governments the taxes to give them the ability to have services and the time to focus on the regulations, which actually would make a difference. So I am a fan of that in some areas, and I'm sure Rebecca and Rod have views too.
All right. Well, I won't put words in their mouth, but I think we're coming to the end now, and I want to just to attempt to sort of wrap this up a little. I think the messages that I've taken away are, companies do need to get better at understanding what is going on in their workforces. Are people struggling to pay the bills? I've also taken away the message that I should think twice before throwing out words like culture casually, and that I now have a chance to get out of all meetings on Friday. So I'm grateful to all three of you for those insights and for sharing your time with the Global Boardroom today. Thank you very much.
Thank you very much, Andrew.
Thank you.
Well, thank you so much there to Rebecca, Rob, Bruce and Andrew. I really enjoyed that discussion, and I'm also really pleased that on the FT Global Boardroom we spent some time this afternoon talking about the impacts of mental health on the global workforce. Now, as Andrew said, things like mental health, well-being, also financial well-being, which is all part of the same problem, did used to be dismissed before the pandemic by employers sometimes as the softer stuff. But now people are really realising the impact that these things can have on productivity and also the bottom line. So some really interesting ideas there about what companies can do to better look after their workforces. But this is the Global Boardroom, and we'd like to open the debate to you. So if you're on Twitter, don't forget you can tweet ideas to us on the hashtag FT Global Boardroom. Tell us what your company is doing to keep its workforce together during the pandemic. I mean, perhaps you are still working. Let's face it, lots of people are, healthcare workers, people in the distribution and warehouse trade, and you're having to cope with different kinds of challenges to office workers who are often feeling very isolated, away from their main networks, away from colleagues, missing human contact, but also being driven mad by what we call FOMO, the fear of missing out, and obsessively checking technology like Slack and email, which is always on. Well, I've got one very small tip for you if you're somebody who obsessively looks at their emails in the middle of the night. I've been making use of the VIP function on my phone so that I can select my most important boss contacts and then not look at my emails because it will buzz when I get a message just from them. But of course, it would be $1 million question if I told you who those most important people are. Now, one of them may be in this next session, which is a panel of economists chaired by our incomparable FT Chief Economics Correspondent, Martin Wolf. Yeah, and a warm welcome to new FT audience members who are joining us from ft.com and from LinkedIn. Now, it will soon be time for me, Claire Barrett, to hand over to my colleagues in the US for the next part of the Global Boardroom Conference. Hannah Murphy, my colleague and the tech correspondent for the FT in San Francisco, is going to be anchoring the sessions from now until the end of today. But don't worry, I'll be back bright and early tomorrow in London to take over from then. Now, before Hannah takes over, we have one of the key debates of the day, Martin Wolf's panel of economists, who will be discussing how policymakers should tackle the crisis. Now, in a moment, I'll introduce our esteemed panel, but first, I'd like to take a moment to remind you about the interactive nature of these sessions, because, of course, why let Martin Wolf ask the questions when you compose them yourself? Now, if you are on LinkedIn, you will see that there is a live chat where you can submit your thoughts and queries via the feed. And as you'll no doubt know by now, the Global Boardroom attendees can reach the panel via the moderator by using the chat function on the right of your screen and ask some questions there. And what a panel this promises to be. In our lineup today, we have Bill Dudley, the former president of the New York Fed, the chief economist of the OECD, Laurence Boone, Marcus Schomer, the chief economist of global boardroom partner PineBridge Investments, and last but no means least, Carmen Reinhart, the chief economist of the World Bank. Oh, what a panel. The pulling power, of Mr. Wolf. Now, Carmen spoke on Martin Wolf's panel at the last Global Boardroom Conference back in May, before she took on her current role. So it will be interesting to see how her views might have changed. So hold tight. Martin Wolf joins you next.
In a blink of an eye, today's fast-turning tides can bring in the unexpected. At PineBridge Investments, we're built to harness these waves, whether it's the digital revolution, climate-driven change, or a pandemic. That's why we focus on areas of the market where our high-conviction approach can add the most value, and why our team of approximately 200 investment professionals in 21 offices worldwide ventures deeper and farther to decode hidden dynamics and uncover the best ideas now and into the future. Stay ahead in a changing world with active, high-conviction investing by PineBridge Investments.
So, welcome back to our discussion, the Digital Boardroom, and I'm Martin Wolf, and it's my great pleasure to introduce and moderate this discussion of the world economy, where we are and where we might be heading. We have four very distinguished panelists. They are Laurence Boone, who has participated in these sessions before, who is chief economist at the OECD, and Carmen Reinhart, who is now chief economist at the World Bank, and Bill Dudley, who I've first got to know when you were at Goldman Sachs, and was, of course, president of the New York Fed for many years, which is, I think, the second most important position in the Federal Reserve System, and more important than the vice chairman's. And finally, Marcus Schomer, who is the chief economist of PineBridge. So I'm going to start, if I may, with a discussion of where we are in the world economy after not quite a year of COVID-19. It seems amazing that it's not even a year, but it has clearly upended the entire world economy. There's sort of a burst of optimism this week about vaccines and the possibility of vaccines, but huge challenges ahead. So, Laurence, if I could start with you, from your perspective, where are we? And in particular, if you sort of compare with our view a few months ago, do things look better or worse than we might have expected after the first 5 months or so of the crisis?
Hi, Martin. It's a pleasure to be here, and thanks to everybody. As you meant, I would like to be a little more optimistic because everybody got so much hope with the vaccine. But I think compare where we thought we would be about 6 months ago when the OECD published its June economic outlook. We had two scenarios, if you remember. One was a single hit scenario, and the other one, which we said would be equally probable because we know was a second hit, two hit scenario. And we're really starting to be into this second wave. And that has several implications. So let me start first. We did assume at the time that given all the money that was poured into research for vaccine or treatment, something would likely happen fairly quickly, like at about this time or next year. But the time to manufacture and deploy the vaccine and get everybody into it meant that this wouldn't have an impact on the economic outlook before possibly 2022, except for a little burst of confidence. So by this, in the meantime, we will have to live with a two-speed economy across countries, across the world, within countries, and across people and for people. So let me look at within economy. We have two types of sectors. We have those that can actually function nearly normally because we've learned from the wave, and you have about 20% of each economy related to leisure, travel, tourism that cannot operate properly, and that will continue. And we then have two-speed world with the countries that did manage well the crisis from a health and economic point of view, and they're mostly in Asia, and they will continue to do that. We can see that they're recovering more quickly, and then at the opposite, you have those who were really taken by surprise, even for the second wave. And then we run the risk of having a two-speed economy for people, with those like us on this chat who can work from home, as you all can see here, and who can continue and sometimes are even more productive, and those that cannot absolutely do that. And I'm also thinking about the kids missing school, which has, as you know, very long time effect. So that I think where we are, it's not a catastrophe. There's been huge policy support, both monetary and fiscal. But when we look ahead, we will still need that well targeted for at least another year.
So, Carmen, if I may turn to you, I'd be very interested in your perspective on how things look, again, particularly compared with about 6 months ago. And I'd be very interested, especially in how you view the situation in emerging and developing countries. Obviously, a very large part of the world economy. And in this, I've put to one side China, which is obviously sui generis and in a way Laurence has just discussed. So what is your perspective? How bad do things look? I've just been looking at some figures, and I was struck that at the top of the list of countries with very high mortality rates from COVID-19 are many South American countries. So that's particularly striking. So how do you perceive what's going on?
It's pretty devastating in many dimensions. Not just the economic dimension, but also the social dimension as well. So big takeaways. Martin, as you know, we've had these conversations. I was not particularly optimistic. I was not in the group looking for that V shape, which certainly, the point that rebound is not to be confused with recovery. And I think for these countries, recovery, really meaning getting back to your pre-crisis level of per capita income, is going to be a very slow process, a multi-year process. I would highlight that in 1990, 58% of the countries, developing and emerging market countries, had lower incomes than in 1980. I'm not suggesting, that we're heading in that direction, but that's a real danger. And it's the social fabric, as you mentioned. Latin America has been very badly hit. But apart from the fairly well documented economic downturns, there's the issue of poverty spikes. I mean, really big poverty spikes. In the World Bank's most recent report on poverty and shared prosperity, what you basically see is the first global spike in more than 20 years. And at the social level, what you're seeing is new entrants into poverty, women and children being particularly hard hit. And some of the poorest countries, this is also because of, migratory effects being disrupted, transportation issues have arisen. There's also food crises. So it's a very stark picture. And, we have to consider that for many of the poorest countries, about half of them right now are either in a debt crisis or quickly approaching one. So the issue of, I bring this up because the issue of having access and the capacity to do sustained stimulus, whether it's fiscal or monetary, is limited to non-existent. So, as the devastation caused by the crisis, the health crisis lingers, their capacity to deliver is very much diminished. And you're talking about also in many countries, and this is true also in some of the middle income countries, very much true in large tracts of Latin America. The informal sector is very large. And so the issue of a social safety net is limited or at worst non-existent. So it's a very grave situation. And, as to conclude, I think, when we look at 2008, 2009, we say, oh, the global financial crisis. Global financial crisis was a crisis in 11 advanced economies that had big Lehman moment effects on, global markets for a short period, but nothing lasting and deep like COVID.
Yeah, I think that's very important. This is very clear on many dimensions. This is a much more significant economic crisis, let alone the health crisis from a worldwide point of view than the financial crisis was. So let me turn to you, Bill. Actually, I'd be rather interested in your perspective, since we raised it, on how this, in terms of its economic aspects, compares with the financial crisis. But I'd be particularly interested in your perspective on how the monetary policy makers have responded. Obviously, principally those with monetary policy room for maneuver, which is important. And obviously, the Fed is the most significant. So, how would you grade them? And how would you compare their response to this crisis and the crisis itself to the one back in 2008?
So let me just start with just assessing the U.S. economy where we are. Basically, we bounced, I think, faster back in the summer and into fall than people expected. So if you look at how the economy is doing relative to the Fed's forecasts that they made mid-year, the economy has done somewhat better than expected, really due to two factors: tremendous amount of fiscal stimulus and reopening. And if you look at the data, it's still pretty good, but that's looking in the rearview mirror. We're about to see a very sharp slowdown in U.S. economic activity due to two factors. Number one, the pandemic is surging, and this is going to lead to more social distancing, more shutdowns. And so you're going to get the exact reverse of the reopening benefits that you got earlier. And second, policy stimulus. We're sort of at the end of policy stimulus, meaningful policy stimulus for the time being. Monetary policy has done a tremendous job in terms of supporting the economy, cutting interest rates to zero, buying long-term treasuries and mortgage-backed securities, backstopping a wide variety of financial markets, having a very strong commitment to keeping interest rates low for long. And so we have 10-year treasury note yields at 90 basis points. Financial conditions in the United States are very accommodative. So the Fed has done, a good job in providing stimulus to the economy. You can actually see that in terms of the interest rate sensitive sectors. The housing sector and the auto sector, which are sensitive to interest rates, have done quite well. The problem we have on the policy front from the Fed's perspective is they could do more, but even if they did more, it really wouldn't have much further consequence in terms of economic activity. So it's not so much that they're out of ammunition. The problem is that the ammunition they have, if they used it, would not change the trajectory of the economy very much. The second problem is fiscal. We had a huge amount of fiscal stimulus in the spring and summer, and you saw that in the savings rate in the United States jumped up very dramatically. We fell off the fiscal cliff at the end of July. We haven't yet experienced the fall because the fiscal stimulus was so large, and you also got the benefits of the reopening. But the longer we go deeper and deeper into the pandemic, away from that fiscal stimulus, I think you're going to start to see much more meaningful impacts on economic activity going forward. And with the election, the prospects for a sizable fiscal stimulus package, I think, before inauguration has dropped. And I think that's dropped for two reasons. One, obviously, the Trump administration probably doesn't want to do any great favors to the incoming Biden administration. And two, we have these two Senate races in Georgia that are going to have a lot to do with who actually controls the Senate. And it's really hard to imagine that politics are going to be set aside to do a big fiscal package to arrive quickly with those political considerations in place. So I think my own view is we're in a pretty tough place right now. Economy is going to be slowing very sharply. I wouldn't rule out a double dip if the pandemic continues to worsen. And monetary policy can't do very much. That's why Chairman Powell and others at the Fed have been talking about the need for more fiscal stimulus. They're not going to admit that they're out of ammunition, but they're definitely, they understand that what they can do from here is very, very marginal because of what they've already accomplished to date.
Well, you all three in different ways have been projecting pretty grim picture for 2021. Economically, politically, pretty well across the world, with possibly the exception of China and a few other East Asian countries. Marcus, how far do you concur with this view? And perhaps you could cheer us up a bit and say that things won't be so bad, and before we get to the longer term and some of the other issues this raises.
Yeah, let's see whether I can find one or two more positives. I don't disagree with most of what's been said before. Maybe on the margin, I would probably argue that, for example, you mentioned the positive news on the vaccine front. I think the fact that we always knew there will be a vaccine, but now the vaccine is getting really close. I think that very fact will make it much less likely that we see widespread shutdowns, for example, in the US. I think the vaccine news came a little bit too late for Europe, but also, frankly, the crisis in Europe is much, much worse compared to what we're seeing in the US. We get bombarded with our infection numbers all the time on TV here in the US, but the numbers in Europe are 3 times as bad as they are over here. So the shutdowns there maybe were more necessary than they would be over here. But the vaccine news, I think, makes these shutdowns much less likely. So I probably don't share the view that Bill Dudley just laid out, that we may see a double-dip recession in the US. Europe, maybe, if the shutdown is extended, but I doubt we get there in the US. You can also think about a shutdown is really a state decision. It's not so much a government decision. First of all, on the government level, on the federal government level, we have a vacuum of power right now. The outgoing Trump administration surely is not going to shut it down, and the incoming Biden administration doesn't have the levels of power yet anyway. And I think most of the states where the pandemic is raging right now won't shut it down. I think that you've seen over the last couple of weeks already. So I'm not so worried about the shutdown. I'm more worried about another aspect that Bill talked about, and that's the policy support. It's true the fiscal stimulus package that the House passed several months ago has still not gotten through the Senate or the White House. And by the middle of December, the first people who started losing jobs in the millions when the pandemic hit the economy in March, the first of that cohort will start to lose all income support. And that's a problem. If we let that run for 6, 7, 8 weeks, then there will be millions of people who suddenly have no money to buy food, no money to pay the rent. And we will see that in the economy. We'll see that in the economic numbers. That is more the reason I'm a little bit more concerned about the economy and the outlook for the US at the beginning of next year. And on the monetary policy side, maybe lastly, it's true. I agree that the Fed doesn't have a lot of tools left that could provide a significant jolt to the economy. That's absolutely true. It's a fiscal policy story, not a monetary policy story. But why are we not doing what still can be done? Why are 10-year bond yields at 90 basis points and not at 0, where they are in Europe right now? Why is the Fed not stepping in, at least maintaining bond yields at a very low level? Why would the Fed allow bond yields to rise? That to me is very inconsistent and shows that the policy coordination in monetary and fiscal policy, at least in the US, is not really working as smoothly as it could.
Can I just follow up on that before I go to the other parts of the world with you, Bill? So the two questions that arise, I think, which are very, very important here. One is, could indeed the monetary authorities do significantly more? Or would you take the view, well, even lowering the bond yield to 0 wouldn't really make any difference? It's sort of, you would be shooting, but you'd be really shooting blanks. And the second question, which is, I suppose, since you're no longer in the Fed, you can comment on. I mean, I sort of start from the assumption that if the Senate remains in Republican hands, they will be absolutely determined to give Mr. Biden nothing, just 0. And therefore, there will be no more fiscal stimulus. What they want is a disastrous economy, as disastrous as possible, which they will blame on Mr. Biden. And this is not a new play. We've seen it before. Isn't that the plausible bet about the future of policy in the US? And in that case, you would in a sense be agreeing that even if the pandemic isn't going to, the pandemic is not going to get worse, the economic response is going to get worse, or at least not get any better, and the economic prospects could then be really quite grim.
Well, turning first to the issue of could the Fed do more? The Fed could do more. I mean, they're not out of tools. They could do yield curve control where they peg Treasury yields at a lower level. But I think the point is that even if you manage to reduce long-term bond yields by 50 basis points, it just wouldn't have that much effect on real economic activity because you already have a lot of buoyancy in the interest rate sensitive sectors of the economy. Nobody in the U.S. economy is suffering because the cost of credit is not available or is too high unless you're just not credit worthy. So I think that the Fed could do more, but I just don't think it would have that much consequence at this point. In terms of whether the Republicans will, have a scorched earth policy with the Biden administration, I think that depends on, who gets blamed. If the Republicans, just say we're not going to do anything to support the economy as the economy is doing very, very poorly, then they'll get some of that blame. And I think they are vulnerable because the pandemic could have been addressed much better in the U.S. By the current administration. We did not pursue social distancing, mask wearing to the degree that we could have. So we could have had either less COVID, better economy, or the same amount of COVID. We didn't optimize the trade-off in terms of shutdowns to economic activity because we didn't do a very good job in terms of mask wearing and social distancing. So, I think the Republican record on the pandemic is not going to be viewed by most people in the country as particularly sterling. And, I understand that Europe is in a worse position than the U.S. right now, but the U.S. situation is worsening very, very rapidly. there is a website that calculates the rate of reinfection. If I have COVID, how many people do I pass COVID on to? And for 48 out of the 50 U.S. states, that reinfection rate is more than 1. So we're still in exponential acceleration of COVID in the United States. And given the reluctance to shut down again, and the reluctance of some people to social distance, not clear what breaks that dynamic of continued acceleration in COVID in the near term.
Laurence, if I may, I'd like to follow up on, at the moment, just focus on Europe, where you are, and the other sort of big developed economy. As Marcus pointed out, and you pointed out, there's a colossal second wave now across Europe. Things look rather good in the summer, and everybody went to party. And one friend of mine said they all went to party in the Mediterranean, and where there was quite a lot of it around, and they spread it everywhere and brought it back home into Northern Europe, even to Germany. So what are the implications? And as a result, obviously there are lockdowns and voluntary social distancing, and the economic implications of all this look pretty bad. And your second scenario, as you replied, the double hit scenario, was pretty grim. So flesh out a little bit what you think this is going to mean for the European economy, and does it mean they're going to have to reconsider their policy response? You know, in the early stages, one thought, well, the fiscal response is rather good this time, and the Fed and the ECB has been much more responsive than it was last time. But given what's now going on, is it nearly enough?
So I think so there are two questions, and I'll start with the first one that you asked. Actually, I don't know how to gauge the European situation compared with the US, because the situation is very different across US states. It's actually quite different in Europe. So it's true there is this second wave, but it's not managed in exactly the same way. If I'm over-simplistic, the only thing we know to do against this virus at the moment is physical distancing. And it's tracing to isolate people and break transmission channels, right? And then you can contain it. And when it becomes too big, then your hospital capacity is the limit. Every single European country is quite different in their capacity to respect social distancing, to do tracing and isolating, and in their healthcare capacity. What we are seeing is therefore a very different level of restrictions to mobility across Europe. But everybody starts being a little overwhelmed. Now, what does that mean in terms of policy? As I said before, I think there's a lot of better management in terms of sectors. People have learned telework, they learn to function, but we still have sectors. So fiscal policy, and Europe and the Commissioner Gentiloni yesterday called for even more fiscal support, right, for not putting the rules back. So we will need more fiscal policy, and we will need it very targeted to people who are in these sectors, because as Carmen pointed out, the minute you reopen, there's a very strong rebound if the people are still attached to their job. Obviously, if they've been laid off, then it takes time to recruit and so on. So I think we're going to see a little slowdown in activity, probably by no means the same size of what we have seen before, but potentially over the medium term, because that's happening on a weaker economy with weaker firms in some instances, which is why the fiscal response needs to be super strong. Now, how can this fiscal response be super strong? And I think that's where I will answer your question. It has a lot to do with monetary policy. I don't think the question today is whether monetary policy has ammunition or not. Monetary policy has, as Bill reminded us, it can go all the way through yield curve control using forward guidance. But more than that, monetary policy is what is enabling fiscal policy. as long as central banks do commit to actually keep in place the condition for keeping rates low along the curve, then the governments will be able to actually provide the fiscal support that needs to be. And in a way, it's super interesting because that means that it is the central banks that are actually in a position to decide when the money is going to places that are not productive in the short or medium term. So it's I think it's the very powerful combination of these two agents that can keep our economies afloat. It seems to me Europe has learned from the past mistake. We're not talking about fiscal austerity as soon as there is a rebound. There's a huge commitment from the ECB on your very platform yesterday. And this, looking forward, can actually make a huge difference compared to what happened in the financial crisis.
And obviously that's particularly important in Europe, where each country doesn't have their own central bank, and they have a fairly credible collective one. And if it stands behind all the governments, then the governments can do fiscal policy, and if it doesn't, they can't, which has been politically controversial, but it's clearly what the ECB is currently committed to. And I'll come to that. Marcus may have something he wants to say about that. Well, let's come to that later. I'd like to talk to you, Carmen, a little bit more about the situation of emerging and developing countries, because you painted a really grim picture. And after all, this applies, if we leave aside China and the developed countries, it still applies to something like 70% of the world's population. So is the conclusion we should reach from this that the response at the global level of the countries that do have capacity, fiscal and monetary capacity, to the plight of the emerging developing world in the pandemic has been grossly inadequate? And what does that, is the implications of that for them? Because after all, a pandemic is a global phenomenon. And if it's not controlled everywhere, then it's more difficult to, not impossible, but more difficult to control anywhere. So what do you think we ought to be doing that we're not doing to help developing and emerging countries through and to avoid this nightmare possibility of a sort of 10-year legacy of this?
So that's a critical question, Martin, but I do want to hit on one issue that I think so far has been missed in the discussion. We've talked about vaccines, we've talked about monetary stimulus, we've talked about fiscal stimulus, but one part that we haven't talked about, and this applies to the US, it applies to the OECD, and it applies to emerging markets, and even a lot of the low income, is the kind of stimulus that's come from banking forbearance. And the fact that we've had, ample, really, and we see this in middle income countries, we've seen this, a big response to deal with households that have lost their jobs and firms that have no access to working capital or that are temporarily shut down, is basically put in suspension. This actually connects to your question at the international level, because this is the domestic parallel of the DSSI, of the debt suspension, debt service suspension initiative. And I have to wonder, we've discussed here what happens, what are the question marks when the fiscal firepower begins to wane and so on. What happens when the grace periods come to an end? And one issue, Martin, that I want to put on the table, not right now, but I want to put it on the table, is the issue of financial fragility, because this is also, again, it cuts across advanced and emerging markets. And speaking of temporary forbearance, that brings me to what international community has done. In May, the introduction of the debt suspension initiative, the DSSI, was a way of saying, okay, temporarily, whatever you're spending and allocating towards debt servicing, reoriented to emergency COVID-related relief. This is for an initiative for the poorest countries. It's a step in the right direction, but it's had its important limitations in real time. Private sector participation never materialized. So the amounts that were saved, even temporarily, from debt repayment and were able to be deployed to the emergency was much more limited than we had hoped. China's participation, they're the largest creditor to many of the poorest countries, was more limited than what had been hoped for. But, you know, where I think the policy response has been quite forceful is we're seeing, you know, we've seen record amounts of lending coming out of the IMF, the World Bank, the multilaterals, and this has been by and large front-loaded relative to most programs, fairly fast disbursement. So I think, you know, that part of the financial architecture, if you will, has worked well. But looking ahead, of course, you know, neither of these things are sustainable. They are, you know, emergency measures. So to avoid, you know, to conclude on the question that you posed, what can we do to avoid a replay of that lost decade from 80 to 90 that I alluded to also earlier? We have to get on the ball on debt restructuring and debt reduction. And, you know, with creditors, we know from history it's pulling teeth. So the question of getting there rapidly would be a way not of necessarily assuring, but a really giant step towards, you know, faster reestablishment of, you know, capital market access, of just trade finance, and of growth in general. So that's a little bit of what is the next big step, debt restructuring.
So, Marcus, I'd like to follow on that, though. Well, I have perhaps two areas you might like to comment. I'd be interested in your views on Europe and where that might end. But I think, Carmen, I was going to go into the sort of the next stages, and there seem to be two interesting aspects of this. There are many, but if you're looking at the economy as a whole, one is financial fragility. What is going to happen in the financial sector? And I'd like both you and Bill to comment on that. And the other, which I'd like all of you to look at, is the sort of longer term scarring issues, which Carmen has already touched upon, you know, beyond next year. Let's assume that the pandemic itself begins to be brought under control, but it's been an enormous shock. What is it going to leave? Where is it going to leave the world economy in terms of changes in the structure of economies, changes in growth, changes in levels of real income? You know, 5 years from now, we're going to look back and say, well, we had this terrible shock, but we can't see any sign of it anymore. Thank God it's all over. Or are we going to be looking back and saying, actually, this changed a lot, and some of it was good and some of it was really disastrous? So these are things I'd like to sort of go through. Go ahead. So just to give you an indication where I'd want to go in the last few minutes. Anyway, Marcus, how do you see these issues?
Well, let me make three comments then on those three issues you mentioned. First of all, on Europe, I'm more concerned about the politics in Europe. Yes, we hope that we won't relive the fiscal policy errors from the previous business cycle, but I'm not so sure that we won't. Right now, everything looks fine. We had this beautiful package in September, but I can imagine in 2022, at the end of 2021 and early 2022, we have two key elections in Europe, in Germany and in France, and they could be much more impactful on the world than what we're just seeing in the US. If we get the wrong government in power in Germany and in France, we could see a severe Euro crisis, which is sort of has been my real doomsday scenario for quite a while, and nothing so far has pushed that probability any lower. In fact, the economic crisis and the COVID crisis, I think, raises the chances that we will see more populist governments being elected in Europe. Even though maybe in the US we see the pressure from that side is receding, I think in Europe that pressure will still increasing. So I'm still worried about Europe until we get through, in particular, the French elections. Quite interesting what Carmen Reinhardt was talking about in terms of debt relief for especially the poorest countries. I think we do have a template for that, really, don't we? The way the Europeans addressed a very similar crisis in the last business cycle. I think what we need to do is utilize the global institutions, in particular probably the IMF, maybe not so much the World Bank, but more the IMF, to do essentially what the ECB did. Let's push the moral hazard issue to the side. If it wasn't about the moral hazard, then the IMF should buy up as much of the debt as possible and finance it at very low interest rates, which we can do right now in financial markets. I think that would be probably one way to utilize the infrastructure that we have, the global financial infrastructure, to help and relieve some of the debt pressure on at least the poorest countries. And then finally, on the financial fragility, I'm actually not so worried about financial fragility itself, because central banks have proven that they're willing to step in and become buyers of last resort. You know, we used to talk about central banks being lenders of last resort when it's all about the banking system, but now it's about financial markets in general. And central banks have clearly shown their willingness to step in and prevent asset prices from declining and adding on a financial crisis to an already pretty severe economic crisis. So I think, especially myself working in the financial markets, there's a great sense that there's a big central bank put in all markets. If we see dislocations and severe declines in asset prices, central banks will step in and prevent that from happening. That really is their role in the kind of asset-dominated world that we're living in right now.
So, Bill, they're buyers of last resort. They're assuming presumably substantial risk on the balance sheet. Who cares? They used to care, but they don't. And therefore, in central banks, we trust. And at least in the major economies where they're prepared to buy up all this stuff, junk or not, financial fragility is no longer a big issue, though it might be elsewhere. How do you respond to that?
Well, I wouldn't go quite that far. I think, the lessons of the pandemic to date are that the reforms that we made to the core banking system have worked. In other words, requiring more liquidity, more capital, higher quality capital, stress tests. People have not lost confidence in the core banking system. And that's really important. That's really why we had what happened in the fall of 2008. There was essentially a loss of trust in the banking system. We don't have that this time, and I don't think we're going to get there because the banks are much stronger. The problem I think we have is, especially in the United States, the non-bank financial system still has got a lot of structural issues that haven't been successfully addressed. Were not successfully addressed by the Dodd-Frank Act. So the Federal Reserve had to intervene again to help the money market funds. They had to intervene again to backstop the commercial paper market. They had to intervene again to backstop the asset-backed securities market. That all tells you that there's still, an inability in the U.S. regulatory setup to really get their arms around financial stability risk outside of the core banking system. And I think the failure here is the Financial Stability Oversight Council that was supposed to be set up to address that issue. And as we know, that has essentially, it's I guess it's nominally still in business, but the four companies that were designated as systemic and subject to potential regulation have been de-designated. And the FSOC, as far as I'm aware, has been very inactive in terms of worrying about financial stability risk in the non-bank financial system. The last issue we have in the United States is that some of the core regulators of our financial system, the CFTC, the Commodity Futures Trading Corp, and the Securities Exchange Commission, don't have an explicit financial stability mandate. So they're responsible in some sense, but they don't actually internalize that because it's not really the mandate that's been given them for Congress. So we have a lot of work to do in the U.S. In terms of fixing the non-bank financial part of the equation. And that's important because in the U.S., the banking system is actually a pretty small fraction of the entire financial system.
Yeah. So I've got a couple of questions. I'm going to ask a couple of them, very quick answers to one of you, and then the sort of this last question, the longer term. Carmen, A couple of the questions are about vaccine nationalism. The vaccine is clearly going to be rolled out in China, where they don't seem to have many cases, East Asia, the rich countries of East Asia, Australasia, and the developed world. And they bought it all up. What are the implications of that for the plight of the countries you're mainly concerned with? Does that, given that they're relatively young populations, does that not matter? In some countries, as we said in Latin America, there's huge incidence of the disease. So how big a problem is vaccine nationalism from your perspective?
It's a very big problem, and the World Bank has a major initiative on that front, precisely because of the fear that the poorest countries are the last in the queue, and that there's issues in terms of access, because of cost, access, at what time, and so. The World Bank is partnering, a major initiative to help countries, help national authorities access vaccines. The targets are, again, this is, resources are not infinite, but the targets are also, high risk. Starting out the process with high risk, health workers. But it is precisely in the anticipation that, the competition for vaccine is going to mean, big relative price hikes, and then, being last on the queue. On that score, Martin, but, on the very long-term issues, I'll be super quick, but I don't think, when I said lasting poverty and social issues, I think what we're starting to get from the people that work on health-related issues and nutritional issues and educational issues at the bank is that the lasting scars also involve, a heavy hit towards human capital. That, we haven't brought that issue forward in this discussion, but the human capital hit, in terms of education and health, is likely to be in this, in the developing country context, major.
So that's a very good concluding point from you. And Laurence, I'd just like to ask you one question, then your sort of longer term view, but we have to be very brief. So public debt in OECD countries is sort of at recordish levels, but debt is incredibly cheap. So should we worry about it at all or not? And then in the longer term, would your bet be that this is sort of a permanent hit to growth and incomes in the countries of the OECD? Or is actually, even though it's a terrible shock, transitory? So I'm afraid you've only got a couple of minutes to cover those two questions, but I'm sure you can manage it.
Okay, I'll take 10 seconds to say one thing to an answer there and close Europe. It's 12 years, I think, that some in financial market have thought that Europe was collapsed, and it's still there, alive and kicking, and it even moved further with the recovery fund. So I think for the doom spirit that we can have in the future of Europe, that's a point. One thing as well is we're all in this together. Carmen mentioned at the beginning that the great financial crisis was a handful of countries or two handful of countries. This one is very much a global crisis, and we perhaps have a unique chance of restoring multilateralism, right? We need a London moment for this crisis, not only for fiscal policy, as Carmen was alluded, not only for the vaccine, as we talked, but also, I think, for restoring trade to make sure that there's a free flow of medical drugs and equipments. Now, you asked me the question about this sort of race to the trillion from public money that's increasing debt. I think what we fear the most at the OECD is that post-COVID or a few years into COVID, the name of this crisis will be the great inequality. not only because it's affecting the most vulnerable workers, but also because of what was said about education. And there as well, it's affecting the most vulnerable kids, the one with their social economic background that is not good. Those kids don't have computers, they don't have phone, they cannot work from home. So the question that will be asked for the debt is, what have you done with this money? Have you spent it wisely? And I think that's what we now must focus on, put the money where it's needed, and it's needed in education, especially for the kids that are from deprived background. It's needed in the digital economy. We need to equip schools, we need to equip teachers, we need to equip rural areas, and more than important, I think we need to equip SMEs, because SMEs are the one that makes the dynamic of employment. And that's where we want things to go ahead and to go fast. And the last point is, I think we've missed the chance in the last crisis of really addressing climate change and investment there. Investment is good not only because it raises demand today, but because it's paving the way for the type of growth we will have tomorrow. And I don't really think that we can afford today to miss this opportunity, in part because people will ask, again, what have you done with this money? So to conclude, I would say the higher debt level will not be an issue if this money has been spent where it's going to lift growth and growth for everybody. Thanks.
So we've got 2 minutes and 40 seconds. So Bill, in 1 minute, long-term scarring as you see it in the US and perhaps in the world, or essentially transitory shock?
I mean, I don't think we know the answer to that yet. I mean, obviously there will be some scarring. I mean, businesses will go out of business, it will fail, and especially in leisure and hospitality. People will come out of the crisis with a lot more debt, and so balance sheets will be hurt, and they'll have some lasting impact. But we've never gone through anything quite like this since 1918. So I think we want to be pretty cautious about trying to evaluate how much scarring there's going to be versus we have a nice, smooth, easy recovery. I think it's going to take a while to get back to where we were. I don't think it's going to be a quick and easy journey. But that said, if we get the pandemic under control, life will go back to something that looks a little bit like normal, probably relatively quickly.
And Marcus, I'm going to ask you a slightly different final question, but if somebody asked me this, because unless you've got some radically different views on what we've heard, what is the next shock that everybody should worry about?
Wow. Well, apart from the unknown unknowns, like COVID, I guess was, I think to me the next shock to the system could be the future of the EU and the euro. Not looking at anything that could sort of cyclically move us into another crisis. The really shock moment, I think, is if the political trends in Europe go wrong and we get the wrong government in Germany, as I said, the wrong government in France. I think there is a potential that all the tension that still exists in Europe that's covered over right now by a little bit of fiscal solidarity, which I don't think will last, that these tensions will reemerge in an environment where there's a lot more populism already in Europe today, where that creates the forces and intensifies the forces that could pull the EU and pull the euro apart. So that to me is a shock that's already out there on the horizon. We can see the potential. The probability may be low, but the potential is there. So that's something that I'm focusing on over the next few years to see whether that could become the next shock or whether it's just a doomsday scenario that we can put back onto the shelf.
I know that Laurence will disagree on that one, so we don't need to go into that one. I just say I think it's been a very, very rich discussion. The only thing that I think we haven't focused on enough, but perhaps we couldn't, is what all this has done to US-China relations and the world order from that point of view. But that's a big second issue. What is very, very clear, we're in the midst of a massive event with multiple ramifications within our societies and among our countries, between our countries. We don't really know how it will end, but it doesn't seem to me, at least, that it will definitely end next year. It might be changing, but it's likely to be with us. So this is a very big story which isn't over. And thank you very much to the panel. I think it's been an excellent discussion and given us even more reasons to worry about than at the beginning, but at the same time, some things that have gone really quite well. Thank you very much to everybody. And I wish the participants pleasure for the future digital board, the rest of the digital boardroom. Thank you very much.
Thank you. Bye.
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 Thank you, Martin. Hello, I'm Hannah Murphy, the FT's tech correspondent in San Francisco, broadcasting live from our studio in New York. And I'm delighted to be anchoring the remaining sessions of Global Boardroom today. And Martin and his guests have certainly provided us with a great first session. Our speakers were discussing how policymakers should approach the recovery from the crisis, particularly given the world economy was already starting from a place of weakness before the pandemic took hold. Pretty grim picture there with some bright spots. We heard our panelists say, optimism from the prospect of a vaccine is being offset by the fact it'll take some time for that to be rolled out, and the fact that we're going through a second wave of the pandemic, which was initially a worst case scenario for some policymakers. Lawrence Boone of the OECD predicting that we'll continue to see this two-speed economy for a year. Some sectors where you can work from home functioning normally, tech, for example, contrasting with leisure, travel, tourism industries that have been decimated and continue to struggle. And we heard about, while we've seen some sort of monetary and fiscal support, the debt crisis in some economies could hamper efforts to recover. And there was some lively discussion as to whether, from a monetary policy perspective, there are still any levers to pull that can be effective. Panelists were calling for more fiscal stimulus, carefully targeted at specific sectors, debt relief for certain economies. And at the same time, we had policymakers talking about ensuring a recovery is even and accounts for the most vulnerable. So thank you to Martin and our distinguished speakers for fantastic, if not slightly alarming panel there. Coming up next is our look at the M&A environment, hosted by Due Diligence, our very popular newsletter on deal-making and corporate finance. Do stick around.
This is
This is we ever
I mean, if you're feeling a bit lost right now, you're in good company. Steer confidently through crisis with the Financial Times.
And welcome back. M&A slowed to a trickle as the pandemic hit, but that's all changed in the past few months as restructuring moves and a build-up of distressed assets has changed the landscape of opportunity. To explore this further, very excited to have a special session hosted by Due Diligence, our super newsletter on everything you need to know about deal making. And the quality continues as we host yet another very high-level set of panelists. Welcome to Joseph Barata, the Global Head of Private Equity at Blackstone, Head of EMEA M&A at Barclays, Pierluigi Colizzi, and Andrea Kramer, Managing Director at Hamilton Lane. And moderating this session is the co-founder of Due Diligence, James Fontanella-Khan.
Hello and welcome to our due diligence panel. It's been a hell of a year for deal makers. It's been, in fact, a roller coaster year, one where you've seen one of the strongest waves for mergers and acquisitions come to an abrupt stop after the outbreak of the pandemic. In March and April, executives across the world really were kind of drop plans to buy or sell their companies, and their focus shifted solely to shoring up cash. Then suddenly in June, in the summer, in most half of the world, you saw M&A picking up again at a very quick pace. And that happened despite the fact that COVID was still a huge problem. You had a trade war between the US and China. We had no idea who was going to be the next president of the US, and Brexit was still a hot potato. Now we've got a little more clarity, at least we think so. There's good news on the vaccine side, which is giving people kind of hope. And Joe Biden won the election in the US, despite Trump still kind of contesting it. So we're kind of finally moving in kind of having greater clarity, which usually is good news for deal making. So today I've got three great people to talk about this. So thanks for being with us. Before I get started, I'd like to remind the audience that you can submit your questions via the Q&A box on the right-hand side. And don't be shy, I'll be kind of picking up some of those questions and introducing them during our conversation. And also feel free to share your thoughts and tweets on social media using the hashtag #FTGlobalBoardroom. So thanks again for being with us, Joe, Pierluigi, and Andrea. The one question I really wanted to start is kind of getting your assessment on the outlook, really. Where do you see kind of M&A going in this environment, and what might be the main drivers of activity? Maybe I'll start with you, Andrea.
Sure, happy to, and very happy to be here as well. I think that's right. We've seen a pretty material uptick in M&A activity. Certainly, Q1 was significantly ahead of what we saw in 2019. And then, of course, the pandemic hit, and you saw a real pullback in Q2. And a lot of that was investors really redirecting their attention back into their existing portfolios and their investments and making sure that they can protect those positions, maximize liquidity, and make sure that they reposition them as needed. And that really quickly shifted from that kind of war room mentality to, win room. And so kind of moving from defense to more of an offense approach. There is an expectation here that you're going to have to generate some returns, really given a zero rate environment across a lot of these geographies. And, I do think we're going to touch on this later. As I suspect, there's always a conversation around, how much capital is still available in the market. And there is a lot of capital, burning a hole in people's pockets, and certainly will likely, start to be put to work over the near term. So what we expect with some of the changes that you've alluded to, or at least highlighted, is Q4 is going to pick up in a big way. We saw that in Q3. Q4 will really be reorienting around, is the administration likely to increase taxes materially, kind of an unknown factor going into next year. And so we've certainly seen a number of investors reposition their assets to exit here near term. And that hasn't slowed. And, if based on what we see today, Q4 may actually be significantly above what we had seen in 2019. So it's making for a very interesting year.
Absolutely. Joe, what's your view about kind of the main drivers in the M&A market?
Thanks very much, James, for having me, and it's nice to be with you, Andrea and Pierluigi. I think if you look at corporate M&A for a minute, then I'll talk about private equity, which is, of course, what I do. I think the very low cost of capital in this world is driving M&A. It's highly earnings accretive, of course, to either use cash that's earning almost nothing, or to use stock that's trading at a high PE multiple to consolidate and realize synergies, cost savings, what have you. And then in many mature low growth industries, that's the way corporate CEOs are driving share prices because they don't have a lot of organic growth. So M&A comes kind of late in a cycle, particularly in mature industries where CEOs are looking for re-ratings of their share price and continuing to drive that. And I think markets so far have been rewarding consolidators with higher share prices. So I think this is likely to last as long as equity markets remain strong. For our world, corporate private equity does track the corporate M&A market. So when you have lots of big mergers happening, there are divestitures led by non-core businesses or antitrust concerns. Andrea mentioned a kind of an interesting moment where people are selling businesses, entrepreneurs, family-owned businesses, because they're worried about personal taxes, corporate tax rates in the United States. So we have seen some increased private equity deal flow as a result of that. Of course, there was also a need for capital in many of the most affected industries. So there's been significant investments being made in the private equity world and in the public capital markets in the most directly affected travel and leisure-related assets. And so that's been a driver. And you may see consolidation over time in those industries where there is clearly excess capacity now, as people will change their behaviors even in a post-COVID world. And thinking about airlines and the aerospace complex, cruise ships, and group meetings and those sorts of things, events, I think you'll see another leg of M&A there as excess capacity needs to be sort of sucked up.
Interesting. That's a great way to kickstart the conversation. Pierluigi, what are your initial thoughts on what might be the main drivers in the M&A industry?
So thanks, James, for having me. And let me start by saying that I'm positive about the outlook for the M&A market. And I'm positive for three reasons, I would say. The first one is that we've got some secular trends that are backing this market, whether it is ESG, which impacts natural resources, the power and utilities industries, and many others, whether it is technology, which is now so pervasive that it touches every sector. Right? Technology is the biggest sector globally for M&A, with 17% of the volumes, and that's because a third of the deals in the technology space actually come from combinations between technology companies and non-tech companies. Whether it is the cheap capital that Joe was alluded to, or the continuous focus by shareholders on making sure that companies are lean and streamlined, and that there are appropriate carve-outs to break the conglomerate. So there are some secular trends to back the market. Number two, you alluded to it, James, in your introduction. we are hopefully on the verge of a lot of uncertainty going away, whether it is the US elections, once the recount is finally done, whether it is Brexit, hopefully at the end of this week, whether it is COVID with the Pfizer announcement and hopefully the Moderna announcement shortly. All of that will provide stability to the M&A market. And finally, at least for Euro, which is the market where I operate, the macro growth is still going to be quite anemic for the next 6 to 9 months at least. At least that's the expectation of most commentators. And therefore, M&A is one way for corporates to provide enhanced growth and enhanced returns to their investors.
Absolutely. So those are 3 good points there, Pierluigi. Andrea, are there any sectors where you think we might see greater activity? I mean, Joe was talking, obviously, for example, of industries which have been hit pretty badly by COVID, like the leisure industry, the restaurants sector. So which areas should we be looking at for greater activity?
Yeah, I mean, I think the ones that everyone's talking about are the popular sectors are kind of the tech, the software, healthcare are kind of the obvious darlings in this market environment. We do think that there are certain sectors that are more resilient or enduring, and we've seen some of that through the last 8 months. The consumer space, I would say, is somewhat divided and a little less clear. There has been some nice COVID bump that we've seen in some of these businesses as we've all kind of sheltered in place and grown weary with our homes, and so we've fix them up in one way or another. And you've seen that in some of the backlog around building supplies and so forth, and trying to get a contractor in your home is really challenging. And the other thing is just limited experiential opportunities. So things that are delivered to your home, kind of like online gaming, has materially picked up. But of course, we've seen a real reduction in things that are experiential outside of the home, such as anything in the hospitality industry, of course, the travel industry, and so that has had some real impact. The other area, of course, is material and industrial. We've seen a pullback pretty meaningfully in those sectors. Now, again, I think many of these businesses have really experienced the March and April timeframe and have kind of ridden that wave of challenges, and so have they've learned from those experiences, in many ways have adjusted, and they've had the time to adjust. And we do think that there will continue to be some volatility. I realize, of course, the vaccine is something we're all, really excited and thrilled about, but that will take time to play its way through the market. And so many of these sectors will have to adjust meaningfully, during this environment. And part of what we're doing when we're looking at, and I'm sure my partners here are evaluating, the underlying companies. When we're looking at, valuations, there are some adjustments. There's some post-COVID kind of bumps built into those valuations, and so really unpacking a lot of that to try to understand, what growth remains and what value continues to accrue in these underlying businesses as we ride through the next 9 to 12 months.
Absolutely. I mean, one big question is, how do you bridge that kind of value gap in the sector? Because there's been a lot of dislocation. So certain industries have been hit more than others. So that's a big question. Pierluigi, sorry. What are the sectors maybe in Europe that you see are seeing particular opportunities for M&A?
Right. I think what Andrea mentioned applies to Europe as well, for sure. Maybe just to add some situation that may be more specific to this region. Let's take the telecom sector, for example. There are 2 macro phenomena. One is the massive interest of infrastructure funds for infrastructure assets out of telecoms businesses. And they may be better owner given their lower cost of capital. 2 is cross-border consolidation among incumbent going to occur? The incumbent telecom operators are today squeezed between the network operators or network providers, the OTTs, the content providers, and a lot of the value chain has shifted away from the telecom incumbents. So we've got a regulator that is supportive of consolidation. Is that going to happen? Or, utilities. You've got regulated distribution trading at 12 times. You've got integrated utilities. There's one in every country trading at 9 times and including their business distribution, supply, and generation. Does it need to be one in each country? Do they need to have all of the free assets? Banks, Spain, Italy have seen domestic consolidation occurring. With the low rate environment we have, with the massive investments in technology that need to take place, why shouldn't there be cross-border consolidation in the foreseeable future in Europe? So these are 3 other sectors which may see a lot of activity in Europe, in my opinion.
Interesting. And I think I used to be an EU correspondent, and these are 3 sectors that in many ways kind of the European Union has been pushing for greater kind of cross-border consolidation across Europe to kind of build these kind of European champions. So that kind of makes a ton of sense. Joe, we've been talking and writing about dry powder, private equity dry powder for quite some time. Is this the great opportunity for private equity? Are we going to see some of that dry powder being put to work? What are you looking at?
Yeah, I mean, everybody likes to talk a lot about the dry powder and how that money's burning a hole in the pocket and how that drives higher multiples and increased activity. The reality is the industry always is capitalized. In other words, we've never been in a moment where we couldn't make the next investment. Our job is to deploy capital through cycles intelligently. So to us, the dry powder isn't what's driving markets. It's not what's driving valuations. The equity markets continue. Public equity markets is what the reference valuation is, and that really reads across into the private markets. Do I think this particular moment is like the opportunity of a lifetime? Probably not, because there's been so much liquidity. Even directly affected companies have been given a lifeline in the public markets, in the private markets, and their businesses are not yet fully funded. I mean, we're not done with the COVID moment. We don't know what's really going to happen. These heavy capital intensive industries where people have expanded capacity significantly. So I don't think we're completely out of the woods on the directly affected industries. The markets are valuing many of these companies, travel related, as though everything's going to be more or less fine. And so there's not like screaming buying opportunities. There may have been in that brief moment in March and April where companies were really in need of capital. And then anything that's on theme or on trend in the public market, software, healthcare services, pharma services, digital content, e-commerce, direct-to-consumer stuff is valued much higher than it was even a year ago. I think the FANG stocks are up something like 70, 80% since September of last year. So that doesn't create compelling value necessarily. And of course, cost of capital is much lower. So valuations have responded, with the 10-year treasury now sub 1%. We're trying to look at kind of everything else. Companies that have to exist in the physical world, maybe they're industrial, maybe they're essential services, but they're not valued as an echo to, kind of the FANG stocks and assuming that uninterrupted 20% growth can happen forever. But businesses that maybe are the first derivative of some of those trends, where you're providing services, you're providing infrastructure required to deliver an e-commerce product, and where the valuations, while elevated, aren't excessive. And there are many public companies, sort of what we call mid-cap public companies in the U.S. and Europe, market caps sort of between $5 and $15 billion that are kind of overlooked. You don't have to own them if you're a mutual fund manager. They're not in the indexes where we see opportunity. And then again, in the big corporate M&A cycle that we're seeing, assets tend to come out where we can be the buyer of non-core assets that haven't attracted the best talent and haven't been allocated capital, where we can step in and meaningfully improve those businesses. So that's where we're spending time, not quite contrarian, but it's hard to buy the directly on theme assets right now. And as I said, it's very hard to invest in the stuff that was directly affected because those valuations certainly don't reflect much distress.
Absolutely. So we're starting to get some questions from our audience. So thank you very much to the audience, and keep them coming. One of them actually, Joe, is for you, and it comes on the back of the question of dry powder, and they're asking, what is the role that PE can play in the broader global recovery? So,
yeah. Well, I think you're seeing it. Many of our peer firms provided capital that was really needed by companies directly affected, whether it was Airbnb, Expedia, KKR did a food distribution investment, energy assets where there's been huge dislocation, in the demand for energy and related infrastructure. And I think if you look at some of the things in our portfolio company, we're continuing to invest in new, for example, we own Merlin Entertainment, directly affected, the largest collection of visitor attractions and theme parks in the world next to Disney. And we're investing significantly in new attractions, new rides. There's 2 new Legoland parks opening in the next year, one in New York, one in Korea. And we're continuing to invest because we really believe that these assets, drive type assets, delivering great high quality family entertainment will recover. And so we're not shutting these things down. We're continuing to invest. And I think you're seeing that across private equity, which is obviously an important part of the global economy now. And most of our peer firms are continuing to invest in their businesses for recovery and for growth. So I do think we're doing our part in contributing to this recovery in the economy, which will certainly happen.
Excellent. Thank you, Joe. Another question coming from our audience is actually related to something Pierluigi said. You spoke about one of these secular trends being ESG. And so the audience here is asking, how are M&A activities coping with the ESG novelty? So how is M&A adapting with ESG? If you could maybe expand a bit on that.
Well, it has become a mainstream event, starting from the sectors which were impacted first. So, every conversation with an oil and gas company, utility, a mining company, starting 18, 20 months ago, 24 months ago, have pivoted towards what can be done to improve our portfolio from a climate perspective. And that was really the beginning. But since then, every sector has been permeated with it. And today it is a topic which is dealt with in pretty much every conversation. And you've seen, maybe pivoting to another topic, you've seen activist investors ultimately reverting to ESG driven campaigns, which tells you it's really become important not only for corporates, for investors, and management teams are going to be judged against their ESG targets.
Excellent. Thank you for that. I'd like to move on to the US election and the outcome of it, which has seen Joe Biden win the race. Obviously, you've got, as we said, current President Donald Trump disputing the outcome. But let's assume the Biden administration will come into power January 1st. I'm keen to hear your views of how this administration might kind of impact the broader M&A kind of environment on questions like antitrust, trade war, protectionism, its impact on private equity. How's it going to deal with big tech? So these are kind of some of the themes that I'd be interested to hear from you. Maybe we could start with Andrea. What is your impressions? And one thing also to bear in mind, we still have a race, senatorial race in Georgia, which is going to kind of decide whether the Senate will be Republican or Democrat, which obviously could change things substantially. But what are your initial views, Andrea, about the Biden administration?
Yeah, I mean, our takeaway here is that, both the M&A market and the private markets have been through this before. And for sure, we can confirm that, these groups know how to adjust through these, these different government regimes. And our expectation is that it will typically get factored into the price, and we'll see some fundamental adjustments, but nevertheless, don't expect that to materially impact M&A as well as the private markets. Our view here is that it's likely to, as you said, we're still in the process of really getting a sense of whether it's going to be full Democrat, the Senate moves to that policy adjustment, or more Republican oriented. Our view here is that either one of these will likely correlate to higher taxes, but that just based on what we've seen and based on the policy, that the increase is likely, kind of up for debate, as that Senate race plays out. A divided House probably means a little bit more moderation. Either way, business, health, and employment will continue to be a big focus for this administration. And it's likely to be that, the focus will be on real changes here. Probably the tax implication is much more oriented towards wealthy individuals as a result, rather than the corporate tax or the business impact. Our view is that if the Democrats do gain Senate control, this likely is a very bullish scenario for capital markets, both a fiscal stimulus as well as infrastructure spending, which Pierluigi alluded to earlier, which is beneficial. So that will increase the spend pretty materially. If it's a Republican-controlled Senate, we don't really view the spending on stimulus and infrastructure to be quite as prolific. The good thing is for private markets that this will likely have, that the private equity will likely be less of focus in this environment. My point earlier about stimulus is that it will likely happen here, but it won't be as big as expected. So less focus on inflation and higher interest rates, which one would expect is beneficial. We do expect that there will be greater regulation on things like healthcare as well as big tech. The scrutiny around their perceived monopoly power is very likely to be one area of real focus. The other one that we haven't touched on here is that we do expect that credit, and particularly private credit, will have greater scrutiny. And it's very likely that you'll see more regulation around this asset class. And given the growth in this particular space, particularly as it supports investing across M&A, is really one that we would want to watch. The other point that I know has come up in the private markets is retail investors. There was some easing of impediments in the prior administration. Our expectation is that's kind of low, on the tree of things that are going to be a focus point. And the administration is likely to still have some real challenges around trade and geopolitical tension, particularly with with China. I don't expect that will ease anytime soon. I think that's a lot of things that I just unpacked.
Think about the same people who told us you could.
And thanks for that. There's actually one of our viewers is kind of has a great follow-up question on the question of trade that you just kind of raised, and whether we'll see more activity in China, and if it's and he also brings up India as another kind of market where there might be more cross-border activity. How will the trade kind of scenario change in that sense? That's for you, Andrea.
I think you're going to have a retraction to a certain extent on that. I think China, it's hard not to have some interaction with China. What we're seeing in both of those markets is, particularly China, because India is still really dealing with some major COVID impact, and health there is severely worrisome. But in China, I think you're getting a lot of kind of internal investing, so that, for example, a lot of our clients are very focused on how to access growth within China specifically, given the challenges around the noise around trade and investing in things that are going to have that perhaps could be hampered by that that relationship.
Absolutely. Joe, what's your view on the administration vis-a-vis private equity? I mean, often Democrats the rhetoric has been pretty hot from the Warren kind of members of the party, but some see a Biden administration as being more moderate, and especially if you have a kind of Republican Congress. Do you feel that is kind of the ideal case scenario where you have a kind of more of a status quo situation?
I mean, honestly, how we approach investing doesn't really change from administration to administration. I mean, we've been doing this for 35 years, investing in Democratic and Republican environments. I think the economy is this giant organism in the U.S. that sort of rolls on irrespective of sort of who's in the White House. And we're trying to find really good businesses that we can do something with to make them better and deliver for our investors, which are retirees across the world, mostly in the United States, and meeting their pension obligations. So I think our mission is a good one. And, you know, we're not particularly worried about our ability to continue to deploy capital, irrespective of who's in the White House. You know, perhaps you'll see higher corporate taxes that gets factored into valuations very, very quickly. And I don't think it's going to fundamentally change much. Likely with a divided government, which seems the way it's going, you won't have major sweeping policy changes that really would probably affect particular industries rather than the entire U.S. economy. There will be, as there has been in the Trump administration, focus on the very large technology companies, on the whole energy complex in the United States. But for the way we invest capital, I don't think it's going to change much. We're certainly not changing the way we think about sectors or valuation or how we're deploying capital.
So you remain somewhat neutral vis-a-vis the change in government.
That's right.
And on the question of China and India, we've seen a lot of private equity firms recently increasing their investments in India. Is this something a trend that you think is likely to continue despite the rising cases of COVID?
Yes, I think COVID is this sort of ephemeral thing that the world will recover from. It's as concerning in the United States as in India, maybe more so, because the fatality here rates are much, much, much higher even than in India. We happen to be one of the largest investors in the Indian market. Our focus is in control buyouts because we're trying to eliminate some of the things that you can't really diligence, counterparty risk, and we want to be able to attract the best management and to drive operating change and then ultimately control the exit and not invest in highly political sensitive industries. You're seeing what can happen with Ant and, in businesses of that nature. So our outlook for India is very positive. We think it's one of the fastest growing economies in the world. It is a well-governed place that is receptive to foreign investment. It has functioning capital markets. We've been very successful there and will continue to invest. I think Andrea mentioned exposing yourself and your investors to domestic consumption trends as opposed to export-led things. India for a long time has been a place where people invested for the low-cost workforce and the declining rupee relative to Western currencies. I think that's perhaps largely played out. We have BPO investments in IT services companies. We're spending much more time now on domestic consumption plays in India, but it's a market that we quite like.
Interesting. And you did mention Ant. For those who haven't been following Ant Financial, it was meant to list in Hong Kong and Shanghai. And then there were some regulatory issues which were somewhat surprising. The Chinese government kind of blocked the listing. For anybody for a foreign investor investing in China, does this kind of government involvement, still pretty heavy-handed involvement, raise some kind of big red flags for future kind of investment in China? Is this something that concerns you, Joe?
I mean, for our strategy in what I do as a control investor, we don't have to worry much about that. But I do think the discount rate one would apply to a business that's highly politically sensitive I think would have to be a little bit higher as a result of that, because it wasn't anticipated really by anybody. And who knows? I mean, it may all be fine. It's an amazing business. There's very sophisticated investors involved. It likely will be public at some point, but it does raise some concerns.
Absolutely. Thank you for that. Pierluigi, what I'd like to hear from you more is like kind of with Donald Trump in the US, there's a kind of a comeback of kind of America first, a bit more protectionist kind of attitude that has somewhat permeated also elsewhere in the world. In kind of Europe, there's much more kind of sense of protecting European companies from Chinese companies, and the general sense of like kind of a protectionist wave. Is this something you think is going to kind of go away? Is it going to stay? What's your view on the question of protectionism in Europe?
Very appropriate question, very timely one. Very timely because you might have seen yesterday the UK issuing the Security and Investment Bill, and it's just the last country out of most of the European countries. And very relevant because during this conversation we've mostly spoken about what I call tailwinds to the M&A activity. Protectionism is probably the biggest headwind we have. Again, much of the conversation focused around Asia. Let me give you a couple of data. The Asia investments into Europe and into the US have massively decreased in the last 3 years. We're talking about 40% in the US, 80% in Europe. And out of those, every dollar that was coming out of Asia for M&A 5 years ago, 50 cents were coming from China. Today is less than 20 cents. So, all of the G7 countries have foreign direct investment regulations. The European Commission in March issued a new framework for more stringent measures. That is something that is probably here to stay, at least in the short to medium term, and is going to impact the M&A activity. And it's not just blocking deals. Like, you have to look at it on a broader perspective as to the government intervention on transactions, the moral suasion that gets applied to it. Again, we've got prominent private equity investors here. Private equity are, usually they're not blocked. Everybody has come to realize and consider private equity as a mainstream force and a very professional force. We're far away from the days when they were dubbed as locusts in Germany many years ago. But the way private equity at times generates returns, so by putting leverage on their companies or reducing costs, maybe at the expense of workforce or at the expense of R&D at times, has drawn scrutiny from governments. And so at times there need to be some commitments that probably are good for the general good, but may impair the M&A activity in the long term.
So just our readers are sending us some, I think about readers because we are the FT, but in this case, they're viewers, are sending some great questions. There's one about, it's a great follow-up for you, Pierluigi, on whether we're going to see any particular changes in the takeover code in the UK post-Brexit. So it's kind of touching upon some of the things you just said. Do you think there's going to be some serious revisions there?
I don't know. I can't anticipate that. But I'd like to say one thing on Brexit. This was the year where we thought the UK might have suffered a lot from the uncertainty around Brexit. Well, global volumes, announced volumes are down 18%. European volumes are down 14%. UK volumes are up. We've seen some very big trades in the UK, private equity firms investing, Asda, Pennon, we've seen ARM being bought by NVIDIA. It's been a very healthy market. So, hopefully next week we will have.
Was it opportunistic buying because people saw the pound was slightly weaker? It's kind of preying upon British industry, or it was just kind of usual run-of-the-mill business?
I think people have started pricing. After a few years of seeing what Brexit could look like, people have started understanding how to price the risk, and again, hopefully, fingers crossed, next week we'll know more, and that uncertainty will go away as well.
Excellent. I have another great question here on what is the outlook for the distressed debt and debt to equity control market? Andrew, do you feel comfortable answering that?
Sure. I mean, I think there was a real drive towards participating in this. A lot of capital raised. A fair number of investors really focused on trying to take advantage of what they saw post the GFC, and that's just not happened, as we talked about, between valuations that we've discussed and the stimulus plans that we've seen across, all of these markets. It's really buoyed, the underlying fundamentals for many of these businesses, and we've certainly not seen massive dislocations. But there was a very short window as we saw bond prices drop for a number of companies, but that lasted only several weeks. So that said, I would suggest that, as we go into next year, and Joe mentioned this, it's, as we continue to see real trouble around, perhaps healthcare and some of these markets and some of the points we've touched on, and as we focus on liquidity in many of these businesses, this could be a bumpy ride. And it is very possible that, as a result of that, we'll have some dislocations, both in the equity as well as in the credit of many of these businesses. The markets have sustained quite a bit. If the stimulus plans, don't continue to feed into the system, you will have real challenges meeting, expectations and needs for many of these underlying businesses. So it is very possible that we'll start to see some restructurings and some, interesting opportunities for folks like Joe and his counterparts. And then, of course, in the credit side, I think till now we've really seen, I talked to a credit manager just yesterday, and over the last 8 months, they've had about 400 amendments. And I think that the credit markets have been very generous, very supporting. All of us, across every market has been really focused on recovery. And, we've been very hopeful and I think optimistic that we'll have a near-term solution. And it looks like that's possible. If that doesn't happen fast enough for some of these businesses, I think we will start to see cracks in the system. And so as a result of that, and nobody wants to talk about the opportunities coming out of that, and we certainly don't want to be viewed as vultures in the private markets. No doubt, but we will start to see cracks in that system.
Absolutely. So I'm being reminded that we've got 5 more minutes to go. So I'm going to pose another question from our audience. Will the COVID crisis be a trigger for the relaxation of competition authorities' requirements, thus fostering M&A activity? Maybe that's one for you, Pierluigi. Do you think that this is generally kind of, and to some respect, kind of on the back of what Andrea just said about we've got a lot of companies which are in distress. Are we going to make it easier for people to kind of put companies together and kind of maybe allow them to get together, whether in the past maybe would have made it a little harder? Do you think that's a possibility?
I think it's not necessarily COVID. I think at least in Europe, we've seen that trend coming for the last 12 months or so. We alluded earlier to the telecom sector where the European Commissioner spoke. We alluded to the FIG sector, financial institutions, sector where some regulators think consolidation may occur. There was a very interesting case last year, as you may recall, in the rail network sector in Europe, whereby there was a lot of debate as to whether to allow an important consolidation. So I think the regulator are seeing the benefits of, or will be seeing the benefits of larger champions in Europe going forward.
Thank you for that. And then I've got another, I think, great question from the audience about how have due diligence practices, and given that our newsletter is called Due Diligence, I think it's a good question to ask. How are due diligence practices and techniques changed in the middle of the pandemic? And like, how do you basically, I think the question is like, how do you pick an asset when you can't travel as much as you did before or at all in some circumstances? Joe, how do you guys do it?
I think
It's a great question. We've bought, one large company virtually, basically. Now, it's the type of company that doesn't possess physical assets. You don't need to kick the tires. It's Ancestry, which is the largest genealogy, family history, direct-to-consumer subscription business in the world. Terrific company. We were able to analyze that company remotely. There's a lot of data science applications. We have a large data science team to look at the customer cohorts and the stickiness. We spent a lot of time with management remotely. We did actually meet them physically in a socially distanced, safe sort of environment. But that was the kind of company that you could buy. It's a lot harder to buy a manufacturing business or maybe even a professional services firm where the people are so critical. But it's not perfect to not be able to meet people. It's also hard to source new opportunities when you're not out in the world meeting people. It's very much an interactive, iterative investment you need to make in relationships and people. So I think stuff you've had in process already, you can get done. Relationships you have, the value of incumbency becomes much higher. Firms like ours, I think, benefit from this because people know what Blackstone is and they know we're reliable. But we do need to get back to being out in the world, meeting people, forging new relationships, and we all look forward to the day when we can do that.
Well, that's maybe a good way to kind of end our conversation. Unfortunately, we have to leave space for the next panel. I wanted to thank all three of you for this fantastic conversation. Thank you very much for being with us. I'd like to remind our audience that they can follow this session and all the other sessions on demand on the FT Global Boardroom website if you have a professional pass, and we encourage you to do that and share it with your peers. And I'd like to pass back to the FT studio. Thanks again, everyone, for being with us. Have a good day, evening, or afternoon, depending on where you are.
Thank you.
Thank you, Joseph, Pierluigi, Andrea, and James. A fantastic session there discussing this roller coaster year for deal makers. In pretty stark contrast to Martin's session on the gloomy economic outlook, we're seeing this material uptick in M&A activity. And from the sounds of things, Q4 is going to be a bit of a bumper quarter two. Our panelists flagged the low cost of capital as a driver and the resolution of uncertainty, hopefully, around the pandemic, given the vaccine, the US 2020 election, and around Brexit. Sectors-wise, tech remains a darling sector, while we can likely expect consolidation among some of the industries hardest hit by the pandemic, such as travel and leisure. Still, Joseph Barata of Blackstone, he argued valuations, particularly among mid-cap companies that are often overlooked, remain elevated and don't actually reflect much distress, making them harder to buy at this point. Looking at US politics specifically, there were some considerations around whether the Biden administration is going to raise taxes significantly, which is shaking up the market a bit. Meanwhile, the prospect of cross-border regulation continues to weigh on negotiations. But overall, a pretty exciting picture for those in the M&A space. So thank you to all our speakers and to James for steering this very insightful conversation. Next up, we have a very special post-election keynote with Wilbur Ross, the US Commerce Secretary. See you all shortly. Thank you for joining us again. We're now delighted to welcome Wilbur Ross, the US Commerce Secretary, in conversation with the chair of our US editorial board, Gillian Tett. Immediately following this fireside chat, which will also be streamed live on ft.com, we'll have an extra time session with Gillian and FT columnist Megan Green, providing spot analysis and answering your questions. Please do submit them by the box on the right of your screen, as they'll be looking forward to your contributions. And remember, if you're joining the discussion on social media, it's hashtag FT Global Boardroom. Stay where you are. Gillian Tett meets Wilbur Ross next up.
Part of our FT conference, a chance for me to sit down and chat with Secretary Wilbur Ross, who is the Commerce Secretary. I first met him over 2 decades ago in Japan, when he was a private equity investor gobbling up a Japanese bank, which he did very successfully, and went on to do a number of other financial deals in places like Ireland, on top of all the other investments he's made in industrial companies around the world. But for the last couple of years, he has been in the Trump administration's cabinet as Commerce Secretary, overseeing an incredibly wide portfolio that stretches all the way from deregulating industries through to looking at the trade agenda, through to looking at issues like the census, and even looking at things like space. He's actually just managed to get something on the space front through Congress in the last few minutes, I gather. So we might hear about that in a moment. But anyway, the key issue that many people want to know about right now is, what does he think is happening on the trade agenda? What's happening to the economy? And also, I have to ask, what is happening on the political front too? So Secretary Ross, thank you very much indeed for joining us today. It's great to have you. You're talking to us by telephone instead of by video, but so it's great to have you in any form, but of course it's a new medium these days. Perhaps I'll start by asking very quickly the question that everyone does want to know right now before we talk about the economy and trade, which is, who do you expect to be sitting in the White House come January? If you can comment.
Well, I think the president has made clear his view. His intention is to make sure that he uses every means possible to make sure that every legitimate vote is counted and that every non-legitimate vote is not counted. He's confident that he will be reelected, and we'll know soon enough. As you know, there's a lot of litigation underway, a lot of states recounting, but regardless of who's in the White House, there's also another key event coming, and that's the runoff election in Georgia. And that will be particularly significant on the off chance that you have a Biden presidency.
Right. Okay. So a lot uncertain on the political front as far as you're concerned, but let's turn to the economy. What do you think is happening to the economy right now? Are we in a recovery situation as the markets appear to have started positioning themselves for in the last few days following the news about the vaccine? And if so, what does that imply, say, about growth and inflation going forward?
Well, the economy before the pandemic obviously was very, very strong and had been led by the consumer. Consumer typically is very close to 70% of our total economy, and all the elements of consumer spending had been very much intact. There was rising employment, rising workforce participation, rising wages, especially among non-supervisory employees of every ethnicity. There also was very good consumer confidence statistics. In fact, the biggest problem that CEOs came to see me about in the early spring of this past year, pre-pandemic, was the problem of finding qualified workers. Roll the clock back to then. We had only 6 million unemployed people, and we had 7.5 million jobs that were unfilled. And that's why President Trump convened the Workforce Initiative, which he had Ivanka Trump and myself co-chair. The reason I'm harping on that is that makes this recession structurally very, very different from the prior one. Prior one came about, like most recessions do, due to excesses in the economy. In the case of the prior one, it was basically mortgage lending excesses. This time, there weren't the excesses. Everything was coming along very, very well, and except we had this exogenous kind of unexpected meteor come crashing into us, and that was the pandemic, courtesy of China. So that makes it a very different phenomenon in that there's no reason to think we can't get back to that kind of level once we get rid of the coronavirus. And lately you've seen very encouraging signs from a number of pharmaceutical companies. So it's really now a question of when, not whether, we will find solutions. And the president, in an unprecedented move, actually awarded contracts to several of the leading potential pharmaceutical solutions. So there will be 100 million units of vaccine readily available once there is FDA approval. So there won't be a long time lag, just as he has shortened what's normally multiple years time lag to get this kind of a thing authorized. Then normally that's when they build the factories, the production line. Here we have the factories before the approval, so it should be a very rapid transition. Now, what's happening meanwhile confirms the strength of the consumer. We already have recouped 55% of all the jobs that were lost in the March shutdown. And that's partly, as I mentioned, because of the structural change that resulted in this recession. And it's also partly because the president correctly targeted the money to go very quickly and directly to consumers and directly to the businesses that employ them to make payroll. Last time around, the money went to states. You remember the famous so-called shovel-ready jobs. Well, the shovel-ready jobs weren't really ready. And so what happened was the states used the bulk of that money simply to offset deficits that they were already running. Now this time, very different. Non-farm payrolls rose by 638,000 in October. That compares with 672,000 in September. And the October gain was despite a 268,000 person reduction in the government employment. And I'll let you in on a little secret. The biggest factor, in fact, a majority of the reduced government employment came about because of the completion of the 2020 census fieldwork.
Right.
We laid off 147,000 of those workers during that period because they had completed their temporary assignment. So the actual increase in private sector employment was much greater than the 638,000. It was really well over 900,000.
Right.
Second important point is it was very well balanced. The diffusion index, 69%. Construction was up 84,000, manufacturing 38,000, retail 104,000, transportation 63,000, professional business services 208,000, healthcare 79, leisure and hospitality, very interesting number, 271,000. The leisure and hospitality has obviously been one of the most troubled sectors. And lately there have been some very dire financial reports from those industries. As of the end of last month, 19.43% of all securitized hotel indebtedness was delinquent. And the financial problems of the airlines are well known.
So can I just interrupt you and ask you, I mean, given this broad-based economic recovery that you think you're seeing and the amount of employment recovery, are you concerned that we might be heading to wage growth or inflation further down the road? Because that's something which has not been on the radar screen of investors until recently, but would be the implications of what you're saying. Are people sufficiently aware of that threat?
Yes, well, the one good news factor on that score is productivity. Productivity has been increasing at more than a 4% rate. Now, at this stage in the recovery, you would be expecting that because employers tend to lag a bit on the hiring side. But if the way that inflation, wage inflation, could be avoided would be if we had enough productivity. The annual rate of productivity increase in the third quarter was 4.9%, and for the trailing 4 quarters, it was 4.1. So interestingly, the hourly compensation on a nominal basis for the past 4 quarters was up 6.7. So that exceeded even the very strong 4.1 productivity.
Right.
But the other factor is the deficit. The president correctly, in the immediate wake of the problem, wasn't worried so much about balancing budgets or anything of that sort, was worried about getting the money to where it needed to go. However, I think as we roll into next year, we're going to be having a deficit something on the order of approaching $3.5 trillion. And likely there'll be a tendency for that to continue, particularly if you have Democratic control, because if there were a diminution in the deficit, there would then be negative fiscal stimulus for the economy. And it would be surprising if that would be what they would want. Now, why that's important is that while there's no bright line test for exactly where one can afford debt to get to as a percentage of GDP, we're already had been as of June around 126%. Probably we're pushing up around 130%. And if we're adding to the deficit somewhere between 10 and 15% of total indebtedness per year, that's a huge number. And it's been largely offset recently by the Federal Reserve's open market purchases. But they're not going to be able to go on forever buying this $3.5 billion or thereabouts a year. So you have 2 potential sources of inflation: the wage inflation deficit, debt deficit inflation. Interest rates, in terms of their impact on the federal deficit, will come into play only relatively slowly. Secretary Mnuchin has done a very good job of extending average maturity of the federal debt to where it's now something over 70 months, 70 months. So whatever increases in interest rates do come would be coming into effect relatively gradually. But when they do come, when you're talking 30 billion of indebtedness, which is a number we'll be at shortly, every 1% on it is obviously 300 billion, and therefore it's around 1.5% of the economy. So to the degree that you also have interest rates starting to come up, there'll be even more inflationary pressure that'll be brought to bear. So I think next year, calendar 2021, is probably the first time that attention will again turn to debt, again turn to deficit, and again turn to inflation.
Wow. Well, that's quite a sobering warning, to put it mildly. How do you see trade pressures feeding into this? Because, of course, one of the things that has kept inflation low has been this explosion of commerce between the US and China and the wider globalized integration of the global economy. Are you expecting to see any rapprochement between China and the US next year, if indeed President-elect Biden is in office? Should there be? And how do you see trading relations, say, with Europe or India developing?
Well, our total purchases from China are are only a few percentage points of the whole economy. So while it is certainly true that some low-price goods have been coming in from there, a big factor in restraining inflation year over year has been oil and natural gas. Those prices have not been very strong, and those are very big variables. So I think a lot will have to do with what happens there, and that ties back to the economy, because the big reason why oil and natural gas prices have been low has been the economic weakness, particularly the weakness in the travel and tourism industries. So I think there's a lot of variables that will go into that. But I do agree with you that there will be next year at least a lot more conversation about inflationary impact than there have been so far.
Right. Can I ask a different question? I mean, I'd like to ask a bit more about protectionism, but we have a good question given your background, which is this from the audience. We're getting questions in. Even before COVID, there was a clear excess of corporate leverage, and it's only become more extreme. What is your view on this at the moment? Are you worried about the indebtedness of corporate America?
Worried about the what of corporate America?
The leverage in corporate America.
I might try and understand the question. I didn't hear the word.
Are you worried about the levels of leverage amongst American?
Leverage in corporate America? No,
yes.
I think most balance sheets are in pretty good shape. Most of the big commercial banks took very extensive reserves. I think that I don't think that's a big worrisome sector. And you see that in the very well-functioning corporate debt markets right now, and at these low interest rates, the cost to service debt is fairly low. If we get into a more inflationary environment, it could have a bit of a different story. But money right now is relatively cheap. And there's that old saying, debt is not a problem until it suddenly becomes a problem. Right now, I don't think it's something it's not our real worry. The bigger worry is the selective industries like hotels that are undoubtedly going to go through a whole lot of bankruptcy processes. And that will end up, the facilities will stay intact, they'll still be available, but there'll probably be changes in ownership, maybe management, and at the end of the day, their cost structures will probably come down some because they won't have as much debt on them.
Right. I'm just working through, we're getting a stream of questions coming through right now. And so another question I'd like to ask about is the issue of you mentioned about the space developments. Anything you'd like to tell us about what is passing through Congress at the moment on the space sector? And is this something that investors should be investing in right now?
I'm sorry, the connection wasn't very good. Could you repeat?
I wanted to ask you about what you're passing through Congress right now in the space world in relation to space. Should investors be
space, yeah.
Yes, looking for space investments?
The Senate Appropriations Committee has apparently just passed a very large increase in the budget for the Office of Space Commerce. That's a part of the Department of Commerce, and it has been charged by the National Space Council, which is chaired by Vice President Pence. We've been charged essentially with the commercialization of space, and particularly the near-term problem, which may sound very strange to you, but it's a very, very big problem, namely the problem of space debris. There are now some 600,000 objects careening around in orbit, going at speeds in excess of 10,000 miles per hour. These are the debris as a satellite ages, it begins to deteriorate. Little bits of it come off, but they continue in orbit. Many of them very small, but even this very small piece of material can do a great deal of damage to the solar panels that power the satellites when you're traveling into at 10,000 or more miles per hour. So space situation awareness and space debris management is something that would be one of the first things that we try to attack. And you may be aware from the media, very recently, our space station had to take an evasive movement because it was in danger of what they euphemistically call a conjunction, what you and I would call a collision. So it's a very real problem, and space is going to become a huge industry. It's already a $440 billion industry. We think it's heading to $1 trillion in the relatively near term.
Wow. Okay. Well, that's interesting. We are almost sadly, very sadly out of time. So I'm just going to turn to one other question, which we've had a number of comments from the audience asking they'd love your views on, which is simply this. If the votes do end up showing that Joe Biden is indeed the president-elect, will you ask Donald Trump to concede and work with the president-elect to do the best to help the economy and the country?
Well, I think everybody in the national scene is hoping for the best for the economy and will ultimately cooperate. But it's not unusual for close elections to take a while to resolve. We had that with the Gore-Bush election. We've had it with other elections. So there's nothing too unusual about the president wanting to make sure that everything is on the up and up at the conclusion of it. Remember that even on the present statistics, while former Vice President Biden got the most votes in history of any presidential candidate, Vice President Trump got the second most votes of any presidential candidate in American history. So this is a very close race, a huge turnout, very important one. And I think at the end of the day, once the American public is satisfied that the results are proper, whichever way they go, I think things will settle down.
Right. Well, that's certainly a hope that I think everyone listening and watching would echo. And so it just remains for me to say a very big thank you, Secretary Ross, for taking your time to chat to us at this potentially very significant junction of not just America's economic history, but political history as well. So thank you for your time. I'm fascinated by what you said on many of the issues, whether it's a sobering comments about the economic outlook and the debt and inflation, or the rather more cheering prospect of a big boom in space. But anyway, thank you very much. Stay safe. And now I'm going to hand back to Hannah for the next part of the program. Thank you.
This is
Hi there, thanks so much for joining us. I'm Megan Green. I'm a senior fellow at Harvard Kennedy School, but I'm also a regular columnist on global macro issues at the Financial Times. And I'm joining Gillian Tett here, who requires no introduction and who has just done a great job moderating a conversation with Secretary Ross. And I've got some questions for Gillian off the back of that conversation, and I know some of you do too, so I'll work those in as well. First, Gillian, Secretary Ross had a really optimistic vision for the economy, both before this virus hit, but also now in terms of productivity growth in the face of this virus. And so I wanted to ask you, is this a case of Joseph Schumpeter's creative destruction, where old businesses get swept away and new businesses pop up that are more productive? Or do you think we're looking more at a case of just pure destruction in the face of this virus?
Well, I think that's a good question, because it's not just playing into politics right now. I mean, obviously, the Trump administration wants to claim and has claimed that everything was fantastic before COVID hit, which, as we know, was simply not the case. But also, there's a lot of, quarterbacking now about the fact that, in fact, recovery is underway. Very different view from the Federal Reserve, it should be said. I mean, we had Chairman Powell coming out last week and basically saying that even with the prospect of a vaccine coming down the tracks, or even two vaccines coming down the tracks, given what Anthony Fauci told my colleagues at the FT conference yesterday, even with that prospect, you're going to get a lot more lockdowns. COVID is still spreading, and there's a lot of sign that there's problems bubbling in terms of what consumers are doing or not doing, and also small businesses. And there's a case to be made that we've actually not seen most of the pain come through yet, because many companies have been propped up for the moment. So I think that Secretary Ross was putting a pretty optimistic spin on it, to be honest. But I think what's very interesting is to see how investors in the markets right now are responding, because certainly in the last 2 or 3 days, we've had this really quite striking, what might be called reflation trade coming through. And the other thing that's worth noting is that when he points out about the impact of the census on the employment numbers, he is actually absolutely correct. You know, the fact of the matter is that a lot of people were laid off the census. The numbers would have been even better if you took that out of the calculations. And he's also correct to say that what we are seeing in terms of employment growth right now, as we come back from the extreme COVID dip, actually is pretty broad-based. And that is striking. And it also raises the question of, are we going to see more wage growth going forward or not?
Yeah, I mean, I have to say, listening to Secretary Ross, I thought what rang truest in his comments in the economy were his comments on the labor market. Although I think the White House's approach to labor market policy has really focused on deregulation and tax cuts in the hopes that companies use their profits to invest in workers rather than engaging in buybacks and dividends. And we've mostly seen the latter. But so I do think the Federal Reserve had a huge role to play as well in keeping the labor market tight and strong. One thing I would say also is that if you look at Opportunity Insights, they look at granular real-time data. And one thing we do know about the labor market that's not great is that employment for high-income people has actually recovered to where it was before the crisis, but employment for low-income people is still about 20% down from the beginning of the year. So we could be exacerbating inequality, certainly, in this recovery.
Absolutely. I mean, you've written about this quite a bit, Megan, in some of your columns, and that's terrific. And I do think this is one of the key issues, and again, helps to explain some of the election reactions we've seen in the last few weeks.
Yeah, that's right. And sticking on the topic of the economy, I just had a question come in about, you mentioned, Jillian, that the winter might be long and hard, and President-elect Biden certainly warned us of that on Monday. I think most people probably didn't want to hear it off the back of this vaccine, this very promising vaccine announcement. But what's your short-term prospect for the economy in Q4 and Q1? Jay Powell in the last hour at Sintra, the ECB's conference, warned again that the virus still rages. But what are your views?
Well, I think the reality is that whoever's in the White House, and we have to presume at the moment it's going to be President-elect Biden, is going to have a really tough challenge on their hands come January. Because firstly, even if these vaccines coming through turn out to be as good as they appear to be, it's going to be logistically pretty tough to distribute it quickly across the entire American economy, never mind actually manufacturing it. I was speaking to several city mayors a few weeks ago from Seattle and Pittsburgh and Miami, who were making the point that actually, unless there's really clear, aggressively well-organized federal systems in place to distribute these vaccines, it could be very tough. You could either have a Hunger Games situation breaking out across the country, a bit like we saw with PPE in terms of distribution. And unless you get a large proportion of the population vaccinated, that is not going to work in terms of boosting public confidence. And that's before you even start to factor in an issue I've written about in a column, which is up right now, to do with public perceptions of the vaccine. So anyone who thinks that the vaccine is going to be a quick miracle cure immediately is actually fooling themselves. Secondly, even if we do restart the economy, there's been this perception for a long time that the economy was a bit like a laptop, in that if something goes wrong, you just switch off the wretched thing, you reboot it, switch it back on again, reboot it, and ping, the whole thing comes back up again. And we all instinctively project that experience that we all have day in, day out onto the economy, because that's what we live with. But the reality is the economy is not a laptop. When you switch it off and then switch it back on, you've wiped out some files. You might get a few extra files added on top. It's different. And so we are looking at a significant period of dislocation and disruption. And perhaps one of the most significant things that everyone should be thinking about going forward is what that means in terms of digital networks. I took part in a conference earlier this week talking about the impact of automation and digitization on service sector, middle-class service sector jobs. And one thing every company has learned in the last few months is that so much work can be done at home that you may not need the office. And so it's very easy to imagine the next natural step is to say, well, maybe do we actually need highly skilled, highly trained, highly expensive workers sitting in America to do these jobs? Maybe we can actually have more of them offshore elsewhere. And so there's going to be a lot of structural changes coming down the tracks that, again, are going to be challenging to deal with. In the shortish term, I expect stock market optimism to keep rising because markets tend to be very skittish right now. But I think once again, it's going to be detached from the actual underlying reality.
Yeah, I would agree. I think we've hit the long, hard slog part of this recovery, where we had the immediate bounce back, particularly in the absence of more fiscal support. I think companies and individuals are just running down their savings, but that's unsustainable. So I think we've started the hard part of it as we're facing into winter and a resurgence of the virus. Speaking of fiscal support, though, you mentioned propping up companies, and generally that's been necessary to keep the lights on in a lot of businesses that were healthy before. But should be afterwards. But you asked Secretary Ross a question about corporate debt, and I felt like it was a dog whistle for me when he said that corporate balance sheets were in good shape, because that hasn't been consistent with what I've seen in looking at the data even before this crisis hit. So I'm curious to hear your thoughts on the corporate sector and all the leverage it's taken up.
Yeah, I was kind of surprised to hear that as well, because actually I think that simply is not the case at all. You've got a very uneven picture. You've got some companies which are incredibly cash rich. They mostly sit in Silicon Valley right now. And then you have a lot of companies which were borrowing heavily even before the COVID-19 pandemic hit, and for whom this has simply exacerbated the amount of leverage they have. And so I think the reality is that actually you have got leverage issues. It's quite striking that the corporate high yield market and leveraged loan market has actually been recovering in recent days. I think that's a function of general excitement about economic growth, perhaps bailing out some of the more indebted companies. But I do think the issue of corporate leverage is an issue, because yes, Secretary Ross, I would agree with him. He said that interest rates are going to stay low for a long time, or not rise too rapidly. In terms of policy rates, what the Fed sets doesn't guarantee that you're not going to have some kind of reaction to push up market rates. And we just had Goldman Sachs early this week coming out and warning people that 2021 is going to be the year of a steepening yield curve. Again, very much echoing what Secretary Ross was saying. And that could put on more pressure onto a number of indebted companies. And I guess the key point is, the one that you just made, and you've written about so well, Megan, is a rebound is not the same as a recovery. And I think the danger is that a lot of investors forget that distinction right now.
Yeah, that's fair enough. And I'm sympathetic to the argument that it's actually really cheap to carry this debt right now. And it will be for a while. Central banks have promised to keep rates incredibly low for the foreseeable. But the other side of that equation is also corporate profits. And that's the side I think we probably need to be a bit more worried about. So real yields are negative for some companies, at least, and certainly for a lot of countries. So some companies get paid to borrow, so it will be no problem to service that debt. But if those creep up in a positive territory, to your point, and if profits also fall, then I think a lot of companies will get into trouble. Now,
absolutely. I mean, you pointed out yourself. I mean, one of the things that everyone forgets, because they're focusing on nominal rates, is that real rates are negative. And it's kind of ironic that we've basically not only have we got real rates negative right now, but we've got real rates that look negative for several years to come in the future, at a time when investors appear to be trading the markets as if we're going to have a strong recovery. Go figure.
Yeah. That's right. And at the country level, I feel like austerity is starting to come forward again, particularly in the US, which is exactly what happened when Obama won the White House in 2008. And so, we shouldn't be surprised, but I also think it's completely inappropriate because, a country like the US is getting paid to borrow and has so much work to do. And contrary to what Secretary Ross said, that we'll get, significant acceleration in inflation. I will die on this hill. I don't think that's really in the cards at all. What are your views on that?
Well, actually, funnily enough, I've just written a column on that, and partly drawing on conversations I've had with Secretary Ross earlier this week about this. I think that significant acceleration in inflation is fairly unlikely anytime soon, in the sense of producing inflation that would actually damage the US economy. And I think one of the most powerful things that's going to keep inflation in check is not just the question marks about demand, it's also the rise of these digital networks. Because even before COVID, consumers and corporate executives were getting better and better for shopping for goods, services, and labor online, creating global competition. And the lockdown has simply deepened that trend and deepened the ways that we can do that in a way that I actually think will keep inflation muted for a while. However, I do also think, I'm in the camp of people who think that it was a mistake to promise that rates are going to stay low until 2023, because I think what that's done is basically create an incredibly unbalanced one-way bet in the markets that is leading to all kinds of behavior which is not helpful at all. Whether it's everyone getting wildly overcomplacent about the danger of owning 10-year bonds, or whether it's people dashing into all kinds of funky structures like SPACs and things like that. And I don't think you need to have promised to keep rates low until 2023 to provide a supportive pillar for the economy if you are the Federal Reserve. So I know lots of people disagree with me, but that's my strong view. So I actually think that in a funny kind of way, and this is what I've written in my column, having people talk about inflation right now is quite helpful, because it will actually help investors remember that it's actually a two-sided outlook. And I actually think the dangers of people forgetting about the prospect of higher rates and inflation is more damaging for the economy than the dangers of actual inflation.
Yeah, that's a intuitive view. I like that. It's risk mitigation, sort of this threat out there of inflation that neither one of us sees coming, but it's helpful to have it out there. I wanted to ask you about trade, since you tried to engage Secretary Ross on this. And I wanted to ask you, when you look at Trump's Make America Great Again strategy, and you look at Biden's Buy American strategy, the means certainly will be different, I think. But in terms of the actual goals, do you see a whole lot of water between them, or do you think industrial policy is here to stay and the trade war probably won't change that much? What are your views on that?
I actually think, to be honest, that what we're going to be seeing is in many ways a continuation rather than a sudden radical change. Except I think that under Biden, what's going to happen is that essentially protectionism won't be called protectionism. It will be called labor market relations. It will be about working with unions to buy America, support American workers, and it will be presented in a much cuddlier kind of language, if you like. I think the Biden administration, if it does come in, or President-elect Biden, let us say, I think that he will certainly work more closely and collaboratively with European allies and with other allies around the world, including Japan. But when it comes to China, I don't expect a radical shift in policy, because I think that actually the attitudes towards China have hardened right across the spectrum, or political spectrum recently. And so there won't be a big shift. I mean, what do you think, Megan? Because you had this amazing experience in Europe. You spent quite a lot of time working in the German finance ministry. You probably understand it better than many others. Do you expect to see much change?
So I don't, actually. I don't think there's a whole lot of water between the MAGA strategy and the Buy American strategy. I'm not sure I'd call encouraging unionization protectionism necessarily. I think that's more geared towards worker power. But in terms of an industrial strategy, an attempt to bring American companies home, provide credits and tax breaks for companies that create jobs in the U.S. I mean, I think for the first time in decades, there's bipartisan support for that. So that is here to stay. When it comes to how the U.S. approaches China, I think the goals are broadly the same, although President-elect Biden may not be arguing for a wholesale decoupling from China, only a decoupling in strategic industries like tech, of course, whereas I think President Trump was more interested in a wholesale decoupling. I think the chances of a trade war morphing into an investment war and a currency war are probably lower under President-elect Biden. But to your point, I think a Biden presidency will reach out more to our allies in Europe. There it gets a little bit tricky, though, because I don't think the EU quite knows what its position towards China is. There are a lot of differences between EU countries. So, it's not as much of a no-brainer as you might expect, because there are divisions amongst our allies. And President-elect Biden has sort of been vague in terms of some of his concepts like tariffs, we don't think he'll be in favor of them, but he sort of said, well, it depends on what our allies think, and our allies think different things. So that I think will be difficult for the new government to navigate, certainly. Yeah.
It's one of the interesting things because people, are so focused right now on China, or they have been in Washington or Wall Street or Boston, where you're now sitting. They've actually forgotten about the significance of someone like Germany, which is to not have a unilateral perspective. And I don't think I've heard President-elect Biden say anything about Germany and his attitude towards Germany on the campaign trail. Maybe you heard about it because you're more tuned into it, but that's the kind of question which actually could be incredibly important for people watching. It's a long-winded way of saying, I hope you hurry up and write a column about that, Megan. But it's very important going forward.
Yeah, it's true. And ironically, the one country that probably won't really benefit from a Biden White House is the UK in terms of Brexit. I think it's much less likely that you'll get a UK-US bilateral trade deal given Biden's focus on multilateralism. So ironically, a Trump win might have been better for the UK. We'll see. In terms of just going back to the corporate sector, because we have 100 questions on it, are you worried about fallen angels issue? Really quickly, we've got a minute and a half, but are you worried about all these fallen angels? Because I was certainly worried about this before this crisis, but actually given all the liquidity out there, it's become less of a concern as a potential source for dislocation for me.
I think short-term fallen angels will be propped up on the wings, if you want to mix metaphors, on the wings of ample liquidity. It's very striking that if you are in the distressed debt business these days, you're not seeing the kind of boom, of restructuring boom that you had expected necessarily because there's so much liquidity floating around. The big question, though, is are you seeing the creation of a new era of zombies? And I said at the beginning of my comments with Secretary Ross that actually I'd first met him in Japan in the late 1990s. And boy, do we know something about zombies from the Japanese experience. So to my mind, that's going to become an increasingly important question going forward.
Yeah, that's a pernicious issue that's kind of a sleeper one. I think about a third of the companies on the Russell 2000, so small cap companies, were zombie companies before this crisis even hit. So given the amount of leverage the corporate sector has taken on in the US since March, that's sure to increase. So we'll have to watch that. I'm afraid we're out of time, but thanks so much for sharing your thoughts, Jillian, and for moderating that great conversation with Secretary Ross.
And thank you, Megan. It's always great to chat to you. Thank you.
Thank you. A couple more great sessions there. We just heard from Wilbur Ross that President Trump has made clear he will ensure that every vote is counted correctly and that he's confident of his re-election prospects. Mr. Ross said, yes, there's been this dramatic hit to the economy from the pandemic, but he added that employment levels are now rising, jobs are being recouped. He also acknowledged that in the wake of the crisis, the president was less fussed about balancing budgets, but warned that we could see the deficit continue to widen, particularly if Democrats do come into power. Following that session with Jillian and Mr. Ross, we had Jillian and Megan, who were, by contrast, pretty cautious on the economy. Jillian just warned there of a sort of Hunger Games situation in terms of access to the vaccine, the possibility of disinformation and resistance to the vaccine, meaning that it would not be much benefit anytime soon to the economy from what has been portrayed as a very optimistic move. A question over how long some of this current state of play could last. You know, you've got individuals running down their savings, but on a more positive note, no prediction of a significant acceleration in inflation anytime soon from our speakers there. Now let's see what US financial markets are thinking about after the election results. Stay with us for our next panel.
This is
This is
we ever. If you're feeling a bit lost right now, you're in good company. Steer confidently through crisis with the Financial Times.
Welcome back, and hello again to our audience members joining us from LinkedIn for this upcoming session. Since the Biden victory in the US, markets have shown some interesting results. Overall, we've had a pretty impressive rally since the vote. In particular, we've seen some healthy tech stock gains on the prospect of a Biden administration, together with Republicans likely maintaining control of the Senate. We've also witnessed some investor exuberance over the prospect of COVID-19 vaccine, which has given life to some leisure and travel shares, but also hit the likes of video conferencing app Zoom. To give their perspectives on future trends, we're delighted to welcome Michelle Seitz, the CEO of Russell Investments, Edwin Denson, the State of Wisconsin Investment Board's Head of Asset and Risk Allocation, and Jay Yoon, Chief Investment Officer at New York Life Investment Management. Joining you now is the moderator of the session, our US markets reporter, Colby Smith. Over to you, Colby.
Welcome, Jay, Michelle, and Edwin. Thank you all so much for being here today. I'm so thrilled to be having this conversation about the post-election investing landscape so soon after such a historic race that saw one of the highest points of rates of voter turnout in American history in the middle of a global pandemic. Before we turn to the conversation, I just want to take this time to welcome all of our listeners today and our new audience members joining us from LinkedIn for this particular session. We will be taking questions throughout this session from the audience, so please submit those via the Q&A box on the right-hand side of your screen. And if you're joining us on LinkedIn Live, you can ask those questions on the feed, and one of our team members will select those and share it with us. Again, turning to Jay, Michelle, and Edwin, I'm so thrilled again to have you all with us today. It's an incredibly important time to be having this conversation. Joe Biden and his team have already begun the transition process to take office in January. And over the next few weeks, we're going to get a lot more information about some of the key policy priorities of this new administration, as well as some of those key cabinet positions that I think everyone is trying to game out who's going to go where. And all of this is going to have vast implications for markets. So I'm thrilled to have you all here with us. And Michelle, I wanted to start with you because, here we are in a moment where the coronavirus crisis is kind of front and center. And I thought there was no better place to start than here, just given what a significant priority this is going to have to be for the Biden administration. And we've seen record number of cases, record hospitalizations in the U.S. We've seen some states and cities even implement lockdown measures again. But again, we also had some pretty bright news this week on Monday with the vaccine announcement from Pfizer. And investors had called this, the game changer for the global economy and for markets more broadly. So I'm curious from your perspective, how much of a game changer you view this news to be, and if some of the big rotations that we saw in markets this week, whether it was out of tech stocks into value stocks, or if it was, the move out of treasuries and into riskier assets, is going to continue here now that we have this extremely positive development.
Wonderful, wonderful. Thank you. Thank you very much, Colby, and thank you for having all of us. It's great to be with this panel. I would say it's a priority for all of us to manage through the pandemic as best we can. It's not been a question of if, it's been a question of when we can get vaccines, treatments, and testing at scale so that we can get back to whatever our new normal is as quickly as possible. And so I think what you see with the market is it's a probability weighted discounting mechanism, and we don't need good, we just need improvement. And as we've been talking about, and I've been saying for quite some time, biology will drive the economy. Unfortunately, biology has its own way of finding its dial. And so we've been dialing up and dialing back on the home trade versus the road to recovery trade. And I think that's where you see the volatility in the markets the most. But first of all, I would say that the news about a vaccine is certainly a game changer. We welcome the news, but getting that into the global community at scale is going to take time. And so as we see in areas around the globe, whether it's the UK or it's Chicago in the States, we are in dial back mode with people talking increasingly about dislocations and a shift back to a downward move in the recovery that we've seen so far. So again, it'll be a dial up and a dial back. It's a question of how many people can get the vaccine, how many people will take the vaccine, and how quickly can we get back to employment levels that have us on a road to a better recovery. I would say the other thing you asked was about the environment and the stock market industries. Clearly, the value trade, meaning value stocks relative to growth stocks, has been significantly hampered because of the uncertainty of when we will be back to full economic recovery. And I think that will continue to dial up and dial back. But you need on the value factor, you would need per year for the next 5 years, 500 basis points of outperformance to just get back to what a normalized discount would be of the value factor to growth factors. So there are definitely dislocations throughout the market that investors can take opportunity with, but we'll continue to see volatility as we get news coming out about the road to recovery.
Yeah, absolutely. And on that point about the road to recovery, Jay, I wanted to turn to you because, as Michelle noted, we're very much in the early stages of this vaccine process. And there are a lot of open questions when it comes to how this will be distributed and when, a critical mass of people are going to actually have access here. So I'm curious, what are your top concerns as it relates to, the widespread rollout of this vaccine? And are you worried that investors have gotten a bit ahead of themselves here?
Sure. So to restate, Michelle, the preliminary results from the Pfizer vaccine offer tremendous news here. 90% efficacy, I don't think anyone expected that. If that holds, then we can actually contain and possibly have a shot at eradicating COVID-19. Now, with all things being equal, I have to put a lot of caveat on that. A lot of issues, but perhaps that remain. So also high efficacy means people may be more willing to take it. So the adoption issue that Michelle mentioned, hopefully, like the measles, we had a high efficacy with measles and it has wide acceptance. Flu vaccine, on the other hand, has been 30 to 70% efficacy year over year with mutation, and mutation is the other big issue. And so flu vaccine only gets about half of the public actually taking it. So adoption is going to be a very important element. And so, and the other part, as you mentioned, is it'll be a while actually before it gets here to the broader world's population, right? It was developed jointly between Pfizer and a German company here. And therefore, I think it's safe to say that the broader public in the United States and parts of Europe may have access to it sometime in second quarter, hopefully earlier part of second quarter. But beyond that, the world's population is at need. The good news there is there are 40 other vaccines in development. Moderna, with the same RNA technology, is close behind, and they're also very optimistic. But the J&J and AstraZeneca may be a more better solution for the rest of the world because they can be held at room temperature. Back to Pfizer. Now, Pfizer, which is going to be available to us in second quarter, the one, a practical issue, even though Pfizer's done a great job at production and distribution, I think they put a lot of effort, energy thinking about it. It needs to be stored at minus 100 Fahrenheit or roughly minus 80 degrees Celsius. Now, with dry ice, they tell us that it's good for about 2 weeks, and they've got a GPS device in it so they can measure and monitor the temperature as it's delivered, but it's going to be difficult, for that matter, to deliver it to corners of the world that may make it difficult in handling this requirement. Now, the other thing with any virus is, obviously, we talked about adoption, immunity. How long will it last once you take it? And also, the mutation. Now, RNA technology, I'm told, I'm not a healthcare expert myself, I'm told is quickly adaptable to being able to remap mutations. So Moderna and Pfizer feel pretty comfortable that it will be able to handle a certain amount of mutation. Again, I'll leave it at that, not to say too much more about what I don't know. So one last thing about this vaccine, the Pfizer vaccine, is you need to take two shots. First shot, you have to wait 3 weeks for a second shot. Then you have to wait 7 days for it to become effective and have a chance at immunity. So you're talking about 28 days. So again, that's just a slightly additional hurdle. And therefore, the market rally on Monday to the news, markets felt that this is the silver bullet. Not quite yet. And it will eventually, I think, markets are right to be optimistic, because we now have a path to a vaccine. And not only the Pfizer vaccine, but 40 others that are in the pipeline. Hopefully, some of that will come through in 2021, and the world will have access to a vaccine in 2021. Having said that, a little premature, because we're in a situation where here in the US and over in Europe, we have resurgence of COVID, and it's actually getting a little more severe than what we saw here in the US in the summer. Therefore, as optimistic as we are towards that vaccine date, sometime middle of next year, we think between now and then, we have some difficulty. Now, what do you do? As you look towards next year, it's clearly, as Michelle mentioned, the right way to look at the world is normalization. As you head towards that normalization, I think you'll need to look at cyclical value over stay-at-home stocks in the longer term, and we will likely now be a higher chance of a fiscal, now that the fiscal size may not need to be as large and could be more targeted with a certain outcome of this vaccine hope. And so we are anticipating a more optimistic scenario into next year. However, in the meantime, we have to look at a dark winter between now and then.
Yeah, absolutely. And that kind of dovetails well right into my next question to Edwin here. I mean, this dark winter, I think, is top of mind for a lot of investors and people more broadly at this point. I mean, we saw, the depths of a crisis in March and April. And I'm curious if you're concerned at all about us revisiting some of those lows and potentially seeing those market dislocations again, or if we're just simply in a different standing now, given all the Fed and other policymakers have done.
Yeah, well, the answer to your question is, well, both. So yes, we do think that you could see some of the same dislocations start to rise again, but not to the same extreme that we saw in March and April. And the big differences are that in March and April, the initial wave of the pandemic really caught everybody off guard: financial markets, governments, and even the broad population itself. And then after that happened, policymakers had to actually reestablish on both the monetary and fiscal sides that they had credibility in terms of providing a meaningful enough response, again, both on the monetary side and on the fiscal side, to avoid a complete meltdown of both the economy and capital markets. We here think that full support from the monetary side will remain in place. There's no reason to believe that there's any change in terms of the stance of the Federal Reserve, for example, here in the US, in terms of their stance of continuing to do whatever it believes that it will take to keep capital markets functioning. Where there is uncertainty, particularly over the shorter term, is on the fiscal side, particularly here in the US. However, as been stated by the other two participants here on the panel, while there is little doubt that more stimulus is coming, right now the ultimate size and timing does remain a question. So in terms of potential for dislocation, it certainly exists because in this sort of air pocket that we're going through now in terms of fiscal support, the economy could flatten out or even turn down again in the absence of appropriate stimulus soon enough. But financial market dislocation is very likely to be less severe in that environment. And I'd say particularly if you look on the banking side of the economy or in terms of asset classes, looking at something like investment grade corporates where the Federal Reserve has already stepped in to provide direct support, and credit markets more broadly, it's very hard to believe that they could become as dislocated in this, if there is another downturn, again, as we have this air pocket. The Fed, with its willingness to continue providing that direct support and potentially, if it needs to, expanding to other assets, perhaps even equity. And then I think it's also the case that, or we believe that it's also the case that if whatever stimulus does make its way through the political process, if that proves to be demonstrably insufficient, it seems that it would be politically disastrous for politicians of either party here in the U.S. to stand in the way of doing more. So dislocation can certainly happen, but it's highly unlikely to be anywhere near as severe as we saw earlier in the year.
Absolutely. And I want to dive a little bit more into stimulus in just a bit, but we do have a question from an audience member here. Jay, I think this is one for you here. They ask, how has COVID changed the way long-term investors should position themselves? Are there any specific themes or industries to focus on going forward?
Sure.